We have to look for the risk of some shock effect coming in that distorts sort of the euphoria that we've been contending with.
I'm not running away from U.S. stocks, right? But the idea is, do you get a broader market in the coming year?
When we head into next year, we could have shocks from either trade or fiscal policy.
Over time, those higher rates start to bite, and I think the Fed will have to capitulate at some point.
It's really important to stay pro-risk, to stay pro-growth. Just recognize that the range of outcomes is going to be wider.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Here's the good news. It's Friday. Here's the bad news. It's Friday the 13th. The S&P 500 poised for its first weekly loss in a month after a roller coaster week, and there's something spooky going on under the surface of this exceptional U.S. equity story. There have been 9 consecutive days with more declining stocks than gainers, and that is the first time that has happened since 2001. Right now, the state of play is as follows. Futures trying to claw back some of this week's losses as yields go nowhere. NASDAQ futures leading the charge once again, as they have throughout this entire period of time, up 0.7%. Danny, what strikes me again and again is that, and we can make all the puns in the world, that breath just is not so good.
It's really not good, and it's happening both at the end of the year and the earnings season. And you see some really uneven reactions. You see Broadcom up some 14% at one point pre-market versus Adobe falling 14%. As stocks get more expensive, you have this idea that the margin of error is a lot thinner, and what you get is a more bumpy road. You don't get stocks all falling together, something crazy, but you get bad breath and a market that's more difficult to navigate.
At the same time, there is money flooding into U.S. equities, poised for a record $480 billion of inflows this year into U.S. equities. How much of the hiccup right now, Anne-Marie, is just this idea that maybe we're facing some policy uncertainty and we're waiting for some of the optimism just to be borne out?
A ton of policy uncertainty, but to your point, there is this U.S. exceptionalism. When you look at the global equity benchmark, it's closing out one of the worst weeks in a month. When it comes to the policy uncertainty, tax cuts. Now we're starting to get those negotiations when it comes to things like SALT. Policy uncertainty on tariffs. Canada mulling these ideas for retaliatory measures, which could be inflationary. And then, of course, yesterday, Donald Trump came out on the side of the dock workers. Does that mean maybe we're going to have a protracted, long fight when it comes to the dock workers and potentially imports coming to the United States? So much uncertainty on the horizon.
But again, risk markets don't seem to care. And I thought Michael Hartnett from Bank of America's note was interesting in this regard this morning, because he says that the thing that disrupts the equity rally isn't the policy, isn't any kind of tariffs that we would get. It is central banks. He says the time to stop buying equities and to buy bonds is when the Fed turns hawkish, not anything to do with the policy.
Well, maybe we'll get that opportunity next week, although it does seem somewhat unlikely. We do expect that Fed decision on Wednesday, the last of 2025, at a time where it's expected to be 25 basis points. I feel like Christine Lagarde offered up a note of caution yesterday because she came out. She dropped this idea of sufficiently restrictive rates, and yet there was this sell-off on the heels of not enough dovishness. So to Danny's point, Anne-Marie, it seems like there needs to be an overly dovish kind of feeling to really justify some of the moves that we're seeing.
Right, and potentially we're going to get that next year because, yes, it's going to be when the central banks moves, to Michael Hartnett's point, but what's going to be the catalyst that moves him? And is it the change of policies, especially when it comes to the political economy? And all of that is centering around Washington, D.C. in a very protectionist administration to be.
Well, this is the state of play today on surveillance. Coming up, Chris Verrone of Strategas on high expectations for equities heading into 2025. Wendy Schiller of Brown University as Trump considers doubling the SALT write-off limit. And Leland Miller of China Beige book as China signals even more fiscal stimulus. We begin this hour with tech leading stocks higher as traders await next week's Fed decision. Chris Verrone of Strategas, a Baird company, looking ahead to next year. Today, the average 2025 S&P forecast is 66.81, just about 10% higher than the current levels. The bar of expectations for the market is considerably higher today than it was a year ago. With sentiment hot, there is small room for error in the first half of 2025. Chris joins us now. Chris, great to see you.
Great to be here.
Welcome back. I just am not going to go with the puns, although I kind of want to. What do you make of the fact that we're just seeing such limited breath or bad breath in the market right now, with so few stocks gaining amid the recent eking out of some of the tech stocks?
Yeah, frankly, I think it's a little overstated. I mean, this is 2 weeks of some squishy internals. It's not 2 months or 2 years. The entire year, 2024, we've had between 70 and 85% of stocks above the 200-day moving average. So this has been relatively broad for most of the year. I think the bar has to be higher before you say, oh my goodness, the breadth is deteriorating to such an extent where it sends this awful message about what's going on under the surface of the market. I don't think we're at that point yet. We're in the middle of December. As we know, it can be a seasonally choppy period here these next 2 or 3 weeks. You tend to resume with strength into January. I think the question, Lisa, will be, does the market justify or does it continue to justify the level of bullishness that's out there? I mean, you start the segment by talking about what the expectations are for next year. So I think as analysts, we have to ask ourselves, is the market still living up to the hype? And that'll be the big question for us over coming weeks.
What is the hype? And I ask this because is it earnings, is it policy, or is it Fed? Which is the most important hype for this market to live up to?
Well, I think there's clearly this awakening of animal spirits. You see it in the targets. The attitudes from the sell side today are remarkably different than they were a year ago. We did that exact same study 12 months ago. The street was looking for basically an unchanged S&P in 2024, and what are we up, 25%, right? So there's clearly a resetting of expectations here. And I don't think that's fatal or catastrophic, but what we've always tried to answer is, does the market justify that level of enthusiasm? And I think the good answer so far is largely yes. I don't think the internals have deteriorated to such an extent. I think the leadership is still pretty pro-cyclical here, but as we write, our margin for error has to be smaller than it has been in the past because the expectations are high. And I think, interestingly, you kind of hint at Europe here a little bit, where the setup's the exact opposite is probably in Europe here. I think the expectations are remarkably low for something to go right here. And it could be any number of things. It could be China getting better. It could be peace. It could be any number of things. But when you're talking about 40 and 42 PMIs in France and Germany, the bar is really low for something to go right there.
A low bar for Europe and China, a high bar for the U.S. I found it so interesting, though, that you've just been on a tour talking to clients.
Yeah.
And a majority saw the next move being 10% lower in the S&P. What did you think about that?
It was such an outlier. We've basically been on the road every day since the election. It's been a busy 6 weeks. I'm happy to be back in New York. But what's been such a consistent feature of all of our client conversations for 4 or 5 weeks is this unleashing of animal spirits. And then something happened over the last week where attitudes have shifted here a little bit. They've become a bit more restrained or modest. I don't know yet if that's an outlier or if people are seeing something. But I'd say on balance, if you look at all of our sentiment indicators, empirically they're falling somewhere between the 85th and 90th percentile historically. So we're kind of right in the zone where you got to maybe watch your back here a little bit because it's never what you know that hurts you. It's what you don't know that gets you. And there's probably something out there that we're not thinking about that could be an issue some point next year.
But this is the thing. And I mean, Lisa started out with this. You so rightly call out that the forecast this time around last year was a gain of less than 2%. And it really paid off to fight the bears. It paid off to not listen to them and go full in. How hard is it to fight the bulls? How hard is it to fight momentum like this, even if at times it seems a little bit on the edge of euphoric?
Yeah, well, I don't think you can yet because I still think the market's living up to the hype, and you see it in a couple places. Number one, credit conditions are remarkably benign here. I think if something meaningful is going to shift out there, you're going to see a deterioration to credit. I think, secondly, the leadership on balance is generally pro-cyclical, right? That's been a tenet of this rally all year. So if I'm going to change the call, I need the consistent stuff to deteriorate, and neither credit nor leadership have really to any meaningful degree. I think the three things you can kind of watch here to maybe shift opinion, notice how post-election equity vol and bond vol have collapsed, right? But what hasn't? Currency vol has not. Currency vol is kind of still near the high as it was pre-election. So I think if something is bubbling or brewing out there that we're not focused on, maybe it emanates from the currency markets here. The dollar CNH looks like it could be lost higher here. We've obviously seen the move in the euro. I think if something, or even dollar yen, I think if something's brewing that's unexpected in 25, it probably comes from currency, not from credit, rates, or equity.
When you say that potentially you're talking to these clients who think, in the last week at least, those final clients on your road trip around America that think we could see the 10% pullback, is the reason because of the policy uncertainty, or they just think maybe we're getting a little bit too lofty with these valuations?
Yeah, it's more the latter. I think, ironically, there's an embrace of kind of what the proposed policies are looking forward. I mean, we were talking about this somewhat casually yesterday in a meeting. There's a kind of a 1980s feel out there right now. It's certainly not lost on me. I do think, speaking in the context of sentiment, again, it's emblematic of an environment where the bar has certainly been raised here. I think the the expectations are pretty lofty going into next year. What we've seen historically is when you've had a change in power, the market tends to run until the inauguration, and then the spring is just a chop. I'm not opposed to the outcome here, but we'll certainly call it as we see it.
You've been constructive on China.
Yeah.
What do you make of the latest we've heard out of China in terms of looser fiscal policy, looser monetary policy, but still very thin on the details?
Yeah, we've always kind of said with China, it's not my opinion or your opinion that matters, it's the market's opinion. And I think the way the market has interpreted the hints of stimulus that you've seen over the last several months from there is different than how it interpreted everything else the last 2 or 3 years. I mean, the momentum surge you saw in September was significant. And I thought the consolidation in the months that followed, the last 2 months, was pretty benign. And you get some kind of renewed signs of life this week. What's important for us in China, consumer discretionary is leading. That's odd for me if we're still in a black hole, recessionary, apocalyptic environment. The financials act pretty well. Chinese tech is breaking out. So I think it would be silly not even to be open to the idea that something's changing out there. And what I encounter traveling and talking to clients is complete resistance to the idea that something's changing. So be open to it. Most people don't even know. China's outperformed this year. FXI's up 40, NASDAQ's up 25. So it's already happening, and there's a complete disdain or neglect for it.
Not a complete disdain. We just saw the biggest inflows into Chinese stocks going back to 9 weeks. So we do see some sort of acceptance of this idea. But I am wondering going forward, putting all of what you just said together and given how high the bar is in the U.S. and how low the bar is in Europe and to some degree in China, are you overweight Europe and China and basically shifting away from some of the high calls in the U.S.?
So we're not overweight those parts of the world yet, but I do think it's a good exercise kind of at the end of the year as the calendar gets ready to turn, just to reset the chip stack and kind of get closer to the benchmark. And I want to kind of get closer to the U.S. benchmark. It's smaller, and I want to get a little bigger elsewhere. I do think there's the potential for good surprises in other parts of the world. If I can make one last point, I would encourage everyone to go look at the European defense contractors. They're all breaking down. When did they break out? They broke out at the start of the war. Is something imminent, peace brewing in that part of the world? I want to be open to that.
I want to be open to that, too. Chris Verrone, thank you so much for being with us. Chris Verrone of Strategas, a Baird company. Always wonderful to see you, and I think that we can officially launch Happy Holidays.
Yes.
Happy holidays. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackes. Yahira.
Good morning, Lisa. The suspect charged in the killing of the United Health Group CEO was not a customer of the insurance. Luigi Mangione and his mother were not members of United Healthcare, dispelling the idea the shooting was motivated by a personal grievance against the country's largest health insurer. Mangione is currently being held in a correctional facility in Pennsylvania while he fights extradition to New York. Meanwhile, Bloomberg reporting Canada is considering imposing export taxes on commodities like uranium and oil if the U.S. imposes broad tariffs. The move would drive up costs for U.S. consumers, farmers, and businesses, and risks causing political divisions within Canada. According to officials familiar, the export levies would be a last resort for the country. And Broadcom shares are rising 13.9% after its fourth quarter results beat expectations. Its artificial intelligence revenue growing 220% compared to the year prior. And that AI growth shows no signs of slowing down. Broadcom expects to see 65% growth in its AI product sales in the fiscal first quarter. That's faster than its overall semiconductor operation, which it expects will grow just 10%. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. They just said AI in the right way. It was sort of really interesting because they didn't really outperform in any other way, Danny. That was sort of interesting.
Yeah, because again, you look at Adobe, who also didn't outperform, performed in line, also mentioned AI, completely opposite treatment. So make of it what you will.
Maybe it's all the Apple rumors. Anyway, we'll talk about that later. Up next, the Trump agenda.
The economy, I believe, is going to be very strong. We do have to solve some problems. They have happened, and I want to get them solved.
That's coming up next. This is Bloomberg Surveillance. trying to break what would be the first weekly loss going back a month. Good morning. Welcome back. We are seeing futures just mildly higher, led by big tech, which has been the main driver of any gains we've gotten so far this week, up 0.3%. We could see a little bit of euro strength, but little bit being the operative word here. Dollar strength across the board otherwise, and really it is the dollar ascendant. Yields creeping a touch higher, but yesterday really climbing through that 433 level. A big question about how much this relates to inflationary pressures and how much this has to do with the deficit. Under the surveillance this morning, the Trump agenda.
The economy, I believe, is going to be very strong. We do have to solve some problems. We have wars going on that we didn't have. We have a lot of things happening that we didn't have that would have never happened. They would have never happened, but now they have happened, and I want to get them solved.
Here's the latest. U.S. President-elect Donald Trump pledging to build a strong economy and cut taxes during a trip to the New York Stock Exchange. Trump's economic advisor is now considering doubling the state and local tax deduction to $20,000. Wendy Schiller of Brown University writing, Trump has momentum and has set expectations high about what he and the GOP can accomplish to improve the daily lives of working Americans. Trump will also have the advantage of passing a tax cut bill by the end of his first year. Wendy joins us now. Wendy, thank you so much for being with us. I want to start with this idea of the SALT tax deduction and this idea that there are only a few members of Congress that are really pushing for this, but margins are so slim that President-elect Trump has to cater to them. What does that tell you about the path ahead and how difficult it's going to be in terms of pushing through all of these agenda items?
Good morning, Lisa. Well, this is the big sort of mystery about the 2024 election. Trump won. He didn't win 50% or higher, but he won, and he won the swing states. And he looks like he's got a lot of momentum, at least with his cabinet nominations and the Senate right now. The House is really a puzzle. There are almost no coattails at all, and the House margin has shrunk. Not only because they didn't do better than they should have in 2024, but because he's selecting people from the House. And in fact, Elise Stefanik, that's a big reward for being so loyal, but she's from New York State, a state that would want, some change in the SALT tax deduction. So this is a real problem for the advocates of changing this particular feature of the tax system back to where it was, or at least improving it for people who come from high tax states. Getting even anything through the House of Representatives, and this is really crucial because constitutionally they originate tax and spend bills, is going to be an enormous challenge for Trump. And he doesn't really care that much about Congress. Most presidents, by the way, don't care that much about Congress. But in this case, I'm not sure what leverage he'll be able to use.
Well, when it comes to SALT, and you mentioned that, we reported that the economic advisors around Trump are looking to raise the SALT cap to $20,000. And then almost immediately you have Congressman Nick LaLota of New York coming out, tweeting the Bloomberg story and saying $20,000 is not reasonable and that he won't vote for anything unless it's a reasonable increase. Just when you take one story like SALT, how difficult is it going to be for Republicans to get that over the finish line, given the fact historically this is the thinnest majority Republicans have ever had in the House of Representatives?
Well, Anne-Marie, I mean, this is, Congress 101, House Politics 101. Mike Johnson, will survive. Trump has sort of indicated he wants him there, and he's going to have to work the line, so to speak. He's going to have to log roll. There will be other features of this tax bill that congressmen, particularly sort of very conservative congressmen from particular districts, are going to want or need. And the second thing is, if you want to log roll, if tariffs really do go in place, and we see the impact on farmers that we did in the first Trump administration, they're going to need subsidy help again. And then New Yorkers, Illinois, California, they have a big agriculture industry actually in all three states. They could benefit by log rolling for both of those constituencies in their state. So this will be House 101. What do you trade to get what you need? And I think Trump generally is likely to stay out of it, but expect his Treasury Secretary to be really working those phones and working those votes as well.
So where are they going to offset the cost for all of this?
Well, offsetting costs seem to be, something Congress doesn't seem to feel like they have to do anymore. I mean, it's been a long time since sort of the grand bargain. And even though bargain technically fell apart, Republicans still got $80 billion worth of cuts in the budget. We haven't seen that in a long time under a Republican president and a Democratic president. So where anybody's going to be willing to cut is, anybody's guess. And the deficit just keeps getting bigger, and the overall national debt keeps getting bigger. And, you can think about economic growth, you can think about a stable economy, but sooner or later that debt will catch up with us.
Well, Wendy, we started out talking that there's disagreements over SALT, but there's disagreements in just even how to phase in these various proposals. There's been reporting this week that John Thune wants basically 2 reconciliation bills, border energy first, tax second. And then you have Ways and Means, Jason Smith, saying, no, we should put it all in one big bill. It'll jeopardize Trump's ability to get tax cuts extended. Wendy, the fact we don't even have an agreement on that itself, on the very basics of what these bills look like, what does that mean for timing? What does it mean for sequencing?
Well, Danny, this is the big sort of curse of a trifecta, because the rules of the House and the rules of the Senate still remain quite different. And the margin in the Senate's a little bit more comfortable. But you still have to think that Murkowski and Collins are a little bit wild card. You just don't know exactly where your votes will be. But Thune can sort of get that through the Senate without a filibuster. Reconciliation only requires 51 votes. He's got enough votes for that. So he's basically saying to the House, if you want a victory, send me a quick bill now, because I can get it through the Senate now. We all know that as things move along, the summer, debt ceilings, appropriations bills, the docket gets crowded. So if you want to get something done and claim victory, you have to do it relatively early in the Congress. And you can see reconciliation is a much more beneficial process because of the rules in the Senate. You won't have a filibuster. You can get it through. This is why Thune wants to do it now. There are always differences between the Senate and House leaders, even if they're the same party. We're just seeing that Mike Johnson has very little leverage because he has such a small minority. He literally cannot guarantee anything to John Thune.
Wendy, you write that you basically need to get some of this through in order to improve the working lives of everyday Americans. Is it your estimation, then, that tariffs won't be able to be passed, at least the most extreme of them, because of the impact on everyday Americans, that it will not be the stock market, but it will be inflation that holds Donald Trump back?
Well, I think that he will use tariffs selectively. That's what I guess. It's hard to predict Donald Trump. Selectively now, because he said he was going to do it. We see that, China, they're not attending the inauguration. I don't think nobody's really that surprised about it. But nonetheless, using negotiation, using sort of overtures of friendship to China rather than tariffs may have been his opening gambit. But maybe if that's all rebuffed, he'll have no choice but to impose, continue some Biden tariffs and impose new ones. Let's see the inflationary effects of those tariffs and the supply chain effects of those tariffs. And if we get to June or July and things are really sort of crunching, then Trump's going to have to, backtrack, and that's going to make him unhappy. And then, as soon as we get to September of 2025, all the House members start looking for the election of 2026. So there isn't really the longest window, but there is a pretty fair, couple of months for Trump to try to see if he can get that balance right where he doesn't trigger inflationary pressure. Because that is something, if he doesn't literally fix the price of eggs, that's what people can, keep talking about, milk, bread, and eggs. If he doesn't fix that, then 6 months from now, the sheen could wear off on him. And with an unstable House, that sort of bodes, danger signals for the Republican Party.
Maybe he can change bird flu. Wendy, I just want to finish up with this. There is this question, especially with the latest discussions around the dock workers, with President-elect Trump siding with them. From the initial signals, is this a pro-labor or pro-business president?
Donald Trump is pro whoever is sort of saying really nice things about him at any given time. That's what we've seen before. He'll try to sort of use both sides against each other to negotiate. That is one thing he likes to do. He likes to be the man in the middle. He likes to be the hero, and he likes to get a deal done. Whether that deal is a good deal or a bad deal for particular parts of the negotiation team, that can be debated. The point is, he likes to do that. So his team around him will try to get him in the room for as many conflicts as possible to get some victories, which makes him happier, which I think we've seen makes him a little bit more reasonable as we progress on a large set of difficult issues.
Wendy Schiller of Brown University, thank you so much for being with us. I just keep going back to that. Which is it? Pro-labor or pro-business?
I think Wendy makes a great point. So whatever the deal is on the table that he has to get through. Yesterday, he was certainly pro-labor when he went to meet the dock workers.
We've got more coming up on that in just a minute. Coming up, we also are going to be speaking with Leland Miller of China Beige book as China promises to backstop the economy, maybe fueling some of the flows that we're seeing into Chinese equities. This is Bloomberg Surveillance. It is Friday the 13th. Welcome back. We're looking at a market that's trying to snap what would be the first week of losses going back to about a month now. We're looking at losses that have been pretty dominant in the broad market, but not necessarily big tech. S&P futures up 0.3%. NASDAQ futures leading the charge as they have continued to do throughout the week, up 0.7%. Russell 2000 futures doing all right today, up about 0.33%. But Danny, yesterday, really underperforming as we really did see just a couple of names leading the charge across the board throughout the past week.
And if you were to say, okay, forget everything you know, just look at the odds for what we're going to get for a cut, you would have said, small caps off to the races. We're pricing in nearly in 100%. I think it's like 97% odds right now that we get a cut. We also have the gift of cuts around the world, but still that's not benefiting small caps. Expectations for a Trump administration, that's not benefiting small caps at this moment. Perhaps it just reflects the hesitancy at the end of the year and the concerns for what the inflationary environment's going to be in 2025.
And to Chris Verrone's point, this idea that a lot of high expectations have already been baked in. So that's something that we saw yesterday with respect to the ECB coming out, cutting rates by 25 basis points. The read-through in yield space was not what you would expect. Take a look. 2s, 10s, and 30s in the United States all inflected higher after yesterday's punishing session, even after an auction that was but it was at least not terrible from the internals. But really in Europe, we saw that sell-off gain steam after ECB President Christine Lagarde came out and didn't really give a sense that she was going to acknowledge some of the deep pain.
Didn't acknowledge it, although she did give a nod to the fact that Europe right now is in political paralysis. But potentially she thinks maybe in 2025 that political paralysis will start to evaporate, given the fact that we're going to get a new French PM and potentially we're going to have elections in Germany. But many say she could have leaned more into it, given on the horizon there's so many unknowns when it comes to trade policy and how difficult it's going to be for the core of Europe to deal with President-elect Trump.
Committing or sort of suggesting 25 basis point rate cuts would be the path forward, even as they were moved sufficiently restrictive to their benchmark target. The euro gaining a little bit versus the dollar, even though the dollar otherwise has been completely ascendant. Maybe part of this has been this idea, Danny, that if ECB President Christine Lagarde isn't more dovish, that might give some sort of relief to a euro that's basically been flat on its back.
Yeah, it's true. But to some degree, maybe you want a euro that's flat on its back in order to deal with some of the tariffs that might be coming and the weak growth. I think it also just underscores and maybe is a preview for what we're going to get next week. This idea that you can't necessarily know which way the bond market is going to be just given on what the headline decision is. We saw that from the Fed last time around, that they cut and yields just move higher. In Europe, they cut, yields move higher. It's unpredictable, and it's at a time where bond market volatility is already very high. It might get higher, especially in the U.S. with concerns around auctions and growing deficits. There are just so many cross currents and so many different things moving this market that it seems like the one constant is just choppiness.
And that's over to you, Fed Chair Jay Powell, on Wednesday, when we might get some sort of choppiness as well on the heels, not just of the rate decision, but also what the telegraph is for 2025. Under surveillance this morning, the latest on this story, United Health Group saying the suspect charged in the killing of executive Brian Thompson wasn't a member of its insurance plans. The company adding that Luigi Mangione's mother was not a member either, dispelling the idea that the alleged shooting was motivated by a grievance from his personal experience with the insurer. Starts to ask the question, begs the question, Danny, how much are we looking at something that speaks to an idiosyncratic moment in someone's psychological trajectory versus some sort of overarching bigger statement?
So the New York Times has a story this morning that's really remarkable that basically tracks the last few months of this alleged shooter's life and kind of the downturn he went into. And what you get is a disturbed picture of someone who travels to Asia. Friends, family can't get into contact with him, severe mental decline, severe feelings of wanting to solve things with violence, which of course is never the answer. It's not something, that should be lionized. And I think that's the kind of picture you get in some of this reporting, is this is someone who is deeply disturbed.
Going back to what the NYPD said, though, the fact he is not a client of United Healthcare, but they said the suspect wrote, that the police talk about in this evidence, quote, does make mention that it is the 5th largest corporation in America, which would make it the largest healthcare organization in America. This is what he wrote going into this tragic murder.
Well, and that will proceed. In the meantime, President-elect Donald Trump expressing support for the International Longshoremen's Association after meeting with leaders. The union preparing for a potential strike on January 15th over the use of semi-automated cranes at port terminals. AMH, we already saw this torpedo some of the operations on docks in the United States. A real kind of about-face from somebody who people can't really identify whether he's pro-labor or pro-business.
Well, he comes out with this statement, and he's clearly backing labor when he says this. And he says he's studied automation and know just about everything there is to know about it. This is his words. And he's basically saying it's not worth it if it's going to put the workers' jobs at risk. The other thing we should note from Donald Trump and the incoming administration, he picked a very union-friendly labor secretary, and that's put a lot of Republicans on edge. But this is the Donald Trump that's a populist, and it is a different kind of Republican than maybe people would be thinking when they think about how he's going to communicate with unions. And you could see that from his cabinet pick, and you can see that from his meeting yesterday.
Yeah, it's a different generation this time around of GOP. Part of the thing that I find interesting is when these negotiations were first going on, when it was Biden's team talking with the ILA, talking with the USMX, the employers for these people, there was this idea that the ILA had so much leverage at the time, they wouldn't get it again, just because they were dealing with the most pro-union friendly government in history, and that the time would pass once we had the election. That's not what's happening. Instead, you're getting another administration. You're getting Trump, who is saying, I support the union members. So it seems like the leverage is back in their hand, which maybe for the employers was a miscalculation to not come to an agreement sooner and just kick the can down the road until closer to the inauguration.
If you're trying to come up with some sort of cohesive, overarching strategy, well, join the club, because that's what's happening around the world. China is one of them, and they have been trying to proactively move ahead of President-elect Trump moving into office. China signaling more public borrowing and spending in 2025. The announcement coming after a 2-day meeting of the Central Economic Work Conference in Beijing. Top officials making a lift in consumption and stimulating overall domestic demand their top priority for only the second time in at least a decade. I want to stick with China for a second, because Leland Miller of China Beige book is going to be joining us. And he writes, the economy is still weak, but not catastrophically so. And thus, Beijing's focus is not boosting the economy. Bigger stimulus will come if Trump's tariffs come, and they need it. Otherwise, they will continue to do as little as they can to keep the economy stable. Leland joins us now. And Leland, I just want to start there. Do you disagree with some of the euphoria that we've seen in certain markets embracing the idea of more Chinese stimulus?
No, of course. But, there's something very different between stimulus that's supposed to juice short-term asset markets and, long-term stimulus that's meant to, restructure the economy and restructure the macroeconomy. So what we've been seeing is, especially last September and October, was stimulus that was meant to juice the stock market. They wanted to get investor sentiment up. And sure, if there's a play in the stock market and the government's saying they're going to backstop you, go in. That's stimulus for short-term asset markets. If you're talking about longer-term stimulus, something that's actually to fundamentally, improve, the structure of the economy, then you have to see what they're doing. And there's been a lot of talk, but there's not been a lot of action. There's this promise now that they're going to pivot to consumption. So now everyone said, oh, well, they said they're going to pivot to consumption. So obviously consumption will be much, much better next year. They've said this many times before. They've gone in and they've done little programs. The question is whether they do something, not one-off voucher here, not one-off voucher there, but something that will actually restructure the economy itself to being more dependent on domestic demand. They've never done that before, and most of it is actually against what Xi Jinping is trying to get at with his economic program. So, call us skeptical right now.
Leland, do you actually believe that it's totally an internal focus at a time when we're hearing about plants being built in Mexico, we're hearing about increased sales to South America, we're hearing about vehicles being built from Chinese companies in Europe in order to sell into that region? How much is this actually internally focused?
Well, that's because that's the export model. So how do you get around tariffs? You build your plants in Mexico or Vietnam or somewhere else. How do you get around other tariffs? You transship through some of these third-party destinations. So if you look back, it depends what domestic means. That's not domestic demand. What you're trying to do is double down, triple down, quadruple down on what is a manufacturing and export model. The problem is that China has the largest goods surplus in history right now. They have the largest trade surplus in history, and the model going into 2024 and 2025 has been we are going to take our exports, which are extremely strong, and we're going to double down. And our imports, which are extremely weak, we're going to talk about doing something about them, but we're not going to actually do anything about them. So you've got enormous political friction. Even if there wasn't a President Trump coming in threatening tariffs, people around the world, countries around the world, are looking at this and saying, "Look, you're flooding us with commodities, you're flooding us with EVs." It's becoming a major political issue across the world, not just in U.S.-China relations.
Leland, how different could it look, though, if it is a transactional relationship with Trump, something that's not broad across-the-board tariffs? And I ask this especially in the context. For example, 3 days ago, Cattle announced that with Stellantis, that they're building a factory, an EV battery factory in Spain. This is something that had planned to be in Michigan, but the Democratic administration and other lawmakers shut it down because of security concerns. This is the kind of thing that maybe Trump wants. Come into the U.S., build here, and we will give you exemptions. Leland, could we see in the future, in 2025, in the preceding 4 years, this type of deal instead happening in the U.S.?
President Trump has said that if you're willing to come here and build, then we will bring you in. You'll probably get a tax cut. You won't hit tariffs. And so there will be incentives for bringing all kinds of foreign production back home. The question is whether there's a national security threat that prohibits that from happening. So when you're talking about Chinese EVs, there's a lot of talk about Chinese EVs being produced in the United States. But the issue isn't only economic, it's national security. These things are wired, shooting data everywhere. There's the Biden administration just came out with something showing the degree to which it's a cybersecurity threat to have Beijing producing these cars in the United States. So not everything is an economic matter. I think if you're broadly speaking, if you're a company willing to come to the United States and produce, then you are going to be welcomed here. But there will be big exceptions, and there will be especially big exceptions when it comes to China.
Leland, in 48 hours prior, we heard that Donald Trump invited Xi Jinping to the inauguration. China saying they're not going to go, but they're going to send a top representative. Everyone could have guessed that was going to be the outcome. But what do you make of potentially the tone this administration is going to be when it comes to dealing with China?
I find out, we've been dealing with this issue for the last couple of days because everyone's so baffled by it. Does no one remember the first term? President Trump at the same time had a very friendly relationship with Xi Jinping while he was levying a tariff war on China. There are two sides of this. So you can be very friendly in terms of how you're talking about the other leaders, and yet being very aggressive when it comes to economic policy. So I think the biggest mistake that Wall Street has been making over the last several weeks is they've been looking at a few personnel picks, or they've been looking at a tweet or two and saying, well, this must be the president moving away from tariffs. This is a president who's not going to be focused on all the things that he's been saying he's going to do for the last 2 years. Quite frankly, I think that's ludicrous. This is going to be a lot more of what the president-elect has been saying. He's going to do what he's saying, and this should be the expectation. Not thinking that a Treasury pick or an NEC pick or someone else is going to push him in another direction for where he wants to go.
Well, there's Treasury pick or NEC pick on one side, but then there's Marco Rubio, Congressman Waltz, and Jamieson Greer on the other, all three who've called for decoupling. Do you think that's the China that Donald Trump is going to be leaning into?
Look, I don't think that the economic platform for the administration has necessarily been crafted yet. You certainly have people with very different views. There are people who think that you need to have a comprehensive economic security strategy with China, which means, obviously tariffs, but also technology restrictions, investment restrictions, supply chain resiliency, defense industrial base rebuilding. And there's other people who are more focused on tariffs. This is the most important thing. We got to get the trade deficit under control. So I'm not sure that this has all been squared away. I think the president's going to listen to the back and forth, and he's going to make his plans based on what he likes at the time. But I think the mistake right now is to think that tariffs are not part of that program.
Leland Miller of China Beige book, thank you so much, as always, for your insights. Right now, let's get you some insights into what's going on over in Europe in particular. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The UK economy contracted for the second straight month in October. GDP again fell 0.1% in the month. The economy only growing in one of the last 4 months since the Labour Party took power. The Office of National Statistics pointed to continued weakness in consumer-facing sectors, including pubs, restaurants, and retailers. Manufacturing and construction output also declined. Meanwhile, big tech's embrace of President-elect Donald Trump continues. Amazon donated $1 million to Trump's inaugural fund, and the company founder Jeff Bezos plans to meet with Trump next week. Amazon is also streaming the inauguration as an in-kind donation that's worth another $1 million. This comes days after Meta also donated $1 million to the same fund. And consumers are still going big at Costco, with the retailer reporting better than expected earnings. Membership rose at the retailer, which is known for selling items in bulk at a better value. Plus, it saw more than 7% rise in comparable sales at stores, while online sales also grew. On the analyst call, executives said furniture has fueled e-commerce sales this holiday season. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I do want to bring you some breaking news. We've been waiting for this all morning, that we have Emmanuel Macron naming a new prime minister in France. His name is Bayrou. He is a member, has been the head of education, minister of justice, Francois Bayrou. He is a moderate, and we will bring you more as we know it. Up next, placing bets for the new year.
The outlook for 2025 is almost kind of two halves. The first half, I think there's a risk to a curve flattener and to rates remaining a little bit elevated.
That's next. This is Bloomberg Surveillance. And coming into what could be the first week of losses in about a month, but we are seeing a bit of a bounce this morning as stocks try to claw out maybe from underneath that, led by big tech once again. S&P futures up about 0.33%. Under surveillance this morning, placing bets for the new year.
The outlook for 2025 is almost kind of two halves. The first half, I think there's a risk to a curve flattener and to rates remaining a little bit elevated. As we get into later next year, we do expect some of the Trump policies, like tariffs and immigration, to really start to weigh on growth a little bit, and they will keep the Fed cautious.
Here's the latest. U.S. Treasury market volatility slumping to multi-year lows as investors increase bets on a December rate cut. But 2025 policy uncertainty creating diverging outlooks. Andrew Szczurowski of Morgan Stanley writing steeper Treasury curves, everyone's favorite trade of 2024. Now, it doesn't come with the same negative carry in 2025, so it will be even more palatable. Andrew joins us now. Andrew, good morning and welcome to the show. I just want to start there. How much are you really watching the yield curve, some of these lack of volatility types of moves, to really understand whether we could see a revival in some of the mortgage market, in some of the originations, as well as some of the transactions there?
Yeah, look, I think it's something a lot of people are looking at, and you've seen the Fed cut 3 times. We expect the Fed to cut next week on Wednesday. But a lot of people are saying, why aren't mortgage rates lower? Why are mortgage rates still close to 7% when the Fed's been cutting rates? And that's because when you look at the yield curve has been steepening over the course of the whole year. And it's something that I expect to continue into 2025. When you think about the kind of divergence between what the Fed's doing and then potential kind of larger fiscal deficits and how the bond market's going to digest that, I think it's gonna require more term premium. So investors should be compensated for going out that yield curve. That doesn't mean there's not value in bonds. I just think the value in bonds is going to come from the kind of short end to belly of the curve, and there's going to be value there.
Andrew, what difference will it make, though, in terms of just how much steeper this trade has to run if you do get a cutting cycle that's cut short next year?
Yeah. Look, when you look at what the bond market's pricing in, the bond market's only pricing in a cut next week, and then they're only pricing in 2 cuts for 2024. If you don't get those 2 cuts, then ultimately you're going to have flatter curves. I ultimately think you're going to actually get a Fed that ends up cutting more than the market's pricing in. When you look at the dot plot, and this is something you're going to get a new dot plot next week, but you actually have 8 members expecting more than four cuts next year. and you have 6 that are projecting, which is the median right now for next year, 4 cuts from the dot plot. But you only have 5 members that are actually above that median. And I think that's something important to look at going into next week is there a change in that dot plot? There might be a little more hawkish tilt there. But I think when you look at that skew, it's more likely that we get kind of closer to that Fed's projection than only 2 cuts. I think when you think about the Fed, they historically don't end at neutral. A lot of people are kind of talking about where neutral is. But I think the Fed's more than likely to go through neutral to go from a restrictive stance on policy to a stimulative one in the coming year.
Andrew, as to kind of solving the conundrum of why we've had cuts and yields have moved higher, there are a variety of reasons, deficit being one of them, the higher term premium required for that. Another thesis has centered on this idea of bond market volatility, that because there's more volatility in this bond market, there's more whipsaws. That in itself requires a higher premium, too. I wonder what you make of that heading into a 2025, too, where some of that whipsaw action, some of that narrative shift, constant back and forth, it doesn't so far have any signs of ending.
Yeah, no, look, that's a great point. I think that one of the things that's kept volatility in the bond market high over the last couple of years has been inflation. When there's this uncertainty on inflation, you should be paid an additional premium in the bond market for that. Now, in the coming year, I expect inflation to continue to subside and that volatility in inflation to continue to subside as well. And I think we're still working off some post-pandemic distortions, but I think those distortions are kind of lessening month by month, and they're going to continue to lessen in the coming year. And with that, I think there'll be less volatility in the bond market, and so maybe we'll take out some of that volatility premium in the coming year that investors should have been compensated for these last 2 years.
Andrew, how difficult, though? I know you think we're going to get more cuts next year, but how difficult is that going to be when we're seeing already the policy proposals of the Trump administration, which is tax cuts, more spending on the border? There's going to be a lot of fiscal stimulus in this economy.
There's going to be a lot of fiscal stimulus in this economy, as you mentioned. I think that it's easier to cut rates for the Fed when you're above neutral, and we don't exactly know where it is till after it's passed. But I still think we're in the kind of easy part of monetary policy where the Fed's not kind of walking around in the dark trying to feel their way around neutral. I think that it gets much tougher as we get in the kind of back half of the year. But I still think that, as you mentioned on the fiscal side, there's these large deficits. That I think there's a lot of kind of campaign rhetoric that might not ultimately come to fruition. Earlier, you were talking about the kind of the small majority in the House. I think it's going to make some of the policies much tougher when there's only a 3 House seat majority when you look at some of the members that are leaving. And so I don't think that the Trump's wish list and Republicans' wish list is going to kind of go through as planned. And I think with that's going to come deficits that maybe aren't as high as feared. And I think you've kind of seen the bond market, rally a little bit since Trump was elected. And I think that's a big part of it.
At this point, Andrew, you're bullish on the prospects of bonds. Why do you think this is going to affect long-end securities, including most mortgages, as much as the short end, which is where everybody seems to be placing their bets?
Yeah, look, I'm bullish on bonds, and I'm bullish on kind of taking credit risk, because I do think that when you look at what happened this year, look, we've had the interest rates back up actually from the kind of 3-year point on the curve and out. So there's actually more value in the bond market today. Yields are higher today, despite inflation coming down, despite the Fed cutting 3 times and likely 4 by the end of next week. And so I just think for a bond investor, when you have this, when you look at kind of where real yields are, they're still extremely attractive. And then we're not advocating just staying in treasuries, though. I think when you look at what credit spreads have come in a lot, but ultimately, if you're a bond investor and you have this kind of decelerating economy, but still a strong economy, that's not a bad environment to take credit risk. So I think that if you can get a 7% yield in a high yield bond, or a 6%, just under 6% yield in a government agency mortgage-backed security, we think those are attractive places to kind of park your money, especially when, if you were rolling your T-bills, you're going to be getting into the kind of 3-handle yields early next year. So I think, and then you think about where inflation is. If inflation's low 2%, well, that's still a very attractive real yield, and that's something that I think people should be kind of moving out that interest rate curve, moving out the risk spectrum.
Andrew Szczurowski of Morgan Stanley Investment Bank, thank you so much for being with us. And I'm looking right now at real yields of 2% on the U.S. 10-year yield. Coming up next, Jared Woodard of Bank of America, Bloomberg's Mike Shepard, Jason Thomas of Carlyle, and former New York Fed President Bill Dudley. Don't miss that on his latest column that just dropped. This is Bloomberg Surveillance.
the equity markets, I see some froth. I'm a little bit nervous.
I would expect markets to broaden out largely because the earnings differentials are likely to moderate.
You want to be positioned in parts of the economy that are growing and also have a high share of domestic revenues.
The consumer resilience is not waning. So they still have some cushion in there across all income cohorts, high, middle, low.
The markets are confused just as the Fed is about the data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back with stocks looking to take back some of this week's losses Friday the 13th as we look ahead to a big week ahead, possibly the last significant week of the year. Fingers crossed as we head toward that Fed meeting. Here's the state of play right now. Equity markets looking to really post a couple gains as we do face potentially the first down week of the past month, really led by the tech stocks. And this has been something that we have seen considerably over the past couple of weeks. NASDAQ 100 up 0.6%. And what you can see in the bond space, yields creeping just a little bit higher after really rising yesterday. And this highlights the uncertainty heading into next week. Given the fact that we have a Federal Reserve expecting to cut by 25 basis points, it is the reaction in markets to the signaling that will matter most. Danny, next week, that Fed meeting, there's going to be a lot of heavy lifting by Fed Chair Jay Powell.
Exactly, because we know 25 is coming. That's already been priced in. The euphoria, I think it's a net 130 cuts globally so far this year, is in this market. Are we going to get a hawkish kind of cut where he basically signals, both him and the dots going forward, that there's going to be some sort of pause, maybe not a pause, maybe another recalibration to understand where inflation is truly going? Yields have already moved higher on the expectation that something like that would happen. Is that where the bias is, that you can again get another cut as you have in the past do decisions and yields keep moving higher?
And every analyst that comes on and says, look at the dot plot, that's what they're most focused on. They've pretty much said there's the green light for the Fed to cut in December. But the issue becomes 2025, to Danny's point. Everyone seems more focused on the dot plot because how are people starting to think about on the FOMC, even if they won't say it out loud, how will they start to think about the political economy changing because of the policies that will be ushered in with a brand new administration?
How do you think they're going to do the dot plot this year? Just put a dartboard up there and throw some things? I mean, I'm
like
serious.
Spaghetti at the wall?
Yeah, pretty much.
Bill Dudley, who I'm so looking forward to speaking to later, his column came out, said basically they can only really incorporate tax cuts because the rest are unknown. I would argue, why even look at the dots then? If the dots literally aren't going to incorporate two of the biggest policy proposals of tariffs and immigration, what's even the use of
some
them?
sort of base case, right, to start the year?
Here's the base case heading into next week in terms of the lineup. We're seeing retail sales coming out as well as personal income and spending. The big event is on Wednesday when we get that Fed decision as well as that Jay Powell Fed rate press conference after that decision, and a real question here about how long the consumer can keep powering the United States exceptionalism. We did get some retail earnings already. A real mixed picture, Danny, and I think that really stands out to me.
A mixed picture, but the ones that are doing well are doing really well. There was Costco yesterday, 7% increase in U.S. same-store sales. They said that wealthier people are kind of shifting down. And again, you could argue, okay, something's not right. More people are spending at Costco. Maybe that's a bad thing. But we were speaking to Holly O'Neill of Bank of America yesterday and said, yes, that shift down is happening, but spending as an overall level is higher. It's just people kind of trying to keep the cushion in their savings account, trading a little bit, but the consumer is still healthy and still spending.
Costco did very well, but one thing I picked up from the CEO talking to analysts is that people are buying what they need, potentially, not what they really want. People are very, very basic buying this year. That's what the CEO had to say.
So be bullish on toilet paper once again. Coming up this hour, Jared Woodard of Bank of America as tech lifts stocks ahead of the Fed. Jason Thomas of Carlyle on the M&A outlook for 2025 in a new report that's really fascinating. And former New York Fed President Bill Dudley on Chair Powell's balancing act and the dot plot during a second Trump term. We begin this hour with stocks higher, boosted by tech, signaling a positive end to an otherwise potentially down week ahead of that final Fed rate decision of this year. Jared Woodard of Bank of America seeing room to run in 2025, writing, we favor equities given upside potential from broader earnings growth, higher productivity and deregulation. In the U.S., prioritize cyclicals with exposure to enduring themes like defense, tech, SMID, industrials, and energy. Jared joins us now. Jared, good morning. Thank you for being with us. Happy holidays. We're launching that today, a special breaking news. Jared, I want to start with this idea of a broadening out at a time where in the past couple of weeks, we've seen a real stalling in that kind of activity. What makes you think we're going to restart and go back to that idea of all of the stocks outside of the Magnificent Seven outperforming?
Well, history's on our side here. If you look at the long sweep of the U.S. equity market, in the 20th century, the average weight in the S&P 500 by market cap to real economy sectors like financials, industrials, materials, energy, those parts of the economy occupied 45%, sometimes more, of the S&P 500. That was the norm. Today, they're much smaller. They're in the 20s altogether, and of course, it's tech and consumer discretionary and communications. These growth stocks that comprise almost 50% of the market. Our view is that as the policy environment shifts, particularly in the United States, as sticky inflation, the higher growth potential as well, make the value of those real economy sectors rise, investors should be positioned for a moderation at the sector level, at the thematic level, because we think there's a lot of potential from deregulation, from earnings broadening out across the economy, and for higher productivity, particularly in the United States, continuing a trend of higher productivity that started even some years ago.
At a certain point, do yields have the potential to stymie this? And we've seen that over the past couple of sessions, just question marks around the deficit, question marks just around how much stickiness there is in inflation. Where do you weigh in on that? How dependent is this theory on yields staying kind of where they are, going lower?
Well, as asset allocators, we think that long-term fixed income, especially government bonds and even investment-grade corporate bonds, may not be as attractive in coming years as they have been in the last few years. We've had this thesis on the end of 60-40 for a number of years now. That's basically played out quite well. If you look at some of the different asset allocation approaches in the market, familiar and unfamiliar, having big allocations to long duration fixed income has been a losing move. If you look at it across the Treasury curve, many parts of the market are actually still underwater from recent years. I'm not worried about a rapid rise in bond yields hurting the equity market. I do think that we may see stickier inflation and stickier bond yields in years to come in a way that makes it more attractive to be in credit and higher yielding parts of the fixed income market and in short duration parts of the equity market, investing in companies that have real profits today, real cash flows today that they can deploy either into their businesses or to shareholders rather than waiting for companies that might not see tangible profits until far out into the future.
Jared, so you're describing a much more active approach to not just this whole market, but the bond market included in that. And we've had plenty of people come on here and say, everybody is an indexer now. The way that people are exposed to bonds are through indices. How unprepared then are investors in 2025 for what you're describing when 60-40 target dated funds and buy the whole market kind of strategies aren't going to work as well?
Yeah, this is an extremely important point because both in the equity and the fixed income markets, we look at benchmarks today and they look more unbalanced than they've ever been. The S&P 500 is something like 2/3 comprised of growth stocks. The U.S. aggregate bond benchmark and other familiar bond benchmarks that many people use are weighted something like 70% toward long duration assets, toward assets that benefit from deflation. Now, I think a more balanced approach is going to be extremely helpful in the future. It's already been a great benefit in the last several years as investors who can weight in a more balanced way across asset classes, capture different risk factors, not just one big deflationary or pro growth stock type risk factor, can achieve better returns and better risk adjusted returns. That's our call for 2025.
Jared, when it comes to broader asset classes, we were speaking with Chris Verrone of Strategas earlier, who pointed out that volatility is low in the bond market, volatility is low in the equity market, but where it's not is the FX market, and especially pairs particularly vulnerable to fiscal policy going forward. How worried are you about a broader contagion that starts and stems from currency markets?
Well, I think if we fast forward 5 or 10 years from now, we could look at one data point from the future that would be valuable to help us allocate across assets today. It would be the level of the U.S. dollar. On a real trade-weighted basis, the U.S. dollar is at the highest since 1985. It's too strong. It prevents American exports from being competitive on the global market. Just as importantly, it prevents consumers in places like Europe and China from benefiting from the wealth that they produce. A rebalancing in the global economy, a slightly weaker dollar, slightly stronger currencies elsewhere, could create the conditions for some really incredible potential growth. Alternatively, if policymakers and leaders can't find a way toward greater balance in the global economy, flows of goods and flows of capital, and the dollar remains as strong as it is, it creates the conditions for a very unpleasant, really kind of a bubble in which there's no alternative to U.S. tech and even to U.S. treasuries for all the capital flowing around the world. I think that what happens with the dollar and whether we can avoid competitive currency devaluation in the years to come is one of the most important trades and questions to answer in the market today.
But Jared, how would policies mean a weaker dollar when the ones that are coming in and being discussed right now by the Trump transition actually call for a higher dollar when you think of things like tariffs?
There's a lot of debate right now on tariffs, on many other policies. I think economic history gives a much different picture than the consensus today. Our economists at Bank of America have written a lot about this, and they suggest even if you take a kind of a standard view on how tariffs and some of these other policies might affect the economy, even in that case, it's a one-time shock rather than a persistent effect on the market. And the effects may actually prove to be quite small. I think there's actually a lot of potential for managing trade relationships, managing flows of capital that many countries have done for a very long time. The West hasn't engaged in that very much. And so the perspective of some of these Western policymakers, including the U.S., is that really we're actually trying to get back to a level playing field when it comes to managing exports, industrial policy, and trade relationships, bringing things to a level playing field that until now have been actually quite one-sided. So if that's true, then it may be that the effects of these policies are much less inflationary, much less stagflationary than a lot of the consensus has believed so far.
Do you believe potentially we'll see a Mar-a-Lago Accord over the course of the next 4 years?
I don't have any special insight, although I do think that there's a lot of potential for leaders around the world to get together and find a new path, not just with their currencies, but with these other bigger picture relationships, to take advantage of some of the potential. You know, in Europe and in China, other parts of the world, policymakers know that overproducing goods export is not going to be a solution. They've been doing it for a while, and it's not working. America knows that running massive deficits and increasing debt to fund unbalanced consumption is not going to be a workable path either. So it's clear there's some potential here for a broad negotiated kind of a settlement. The open question is whether we have the right leaders for the job now and in the future.
Jared, just before you go, you did make this point. I do want to dig a little bit further where you said if you could see one data point to set asset allocation into 2030, it would be the level of the U.S. dollar. Can you give us a sense of how the asset allocation would change if it were strong or if it were weak?
Let's say just DXY getting down to 90 or even to 80, a great global rebalancing in goods and capital. I think that unlocks potential across the market. So deep value, arguably value traps in the market today, places like European and Chinese equities, could suddenly become live options again for investors. Tech sectors, growth stocks, suddenly become much less attractive compared to value. Real assets can perform really well. Alternatively, if there is no real policy leadership on the global stage or there isn't a path to some kind of success and you just see continued excessive dollar strength, let's think about DXY at 120, then the thesis there is just there simply is no alternative to the U.S. market, and the dominance of growth stocks, of tech and treasuries and so on from recent decades would be expected to continue. The danger there, of course, is that's how most investors are already allocated today. That's where the length is in positioning. I think that could set up some really unpleasant overvaluation, even bubble-like conditions that can create a lot of fragility and even volatility in the market at a generational level. I think it's an extremely important policy moment. And given how extreme positioning valuation is becoming, markets are really exposed to what happens in these big picture policy debates in the years to come. It's extremely important.
Jared Woodard, we look forward to speaking to you sooner than that to talk through what some of these policy implications are. Jared Woodard of Bank of America, we really appreciate your time and happy holidays. Right now, let's get you an update on what's going on in France and other stories. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. French President Emmanuel Macron has named Francois Bayrou to be France's new prime minister. The pick is the long-standing centrist ally. Bayrou will take over for Michel Barnier, who resigned last week after far-right and leftist coalitions united to topple the government. The incoming prime minister will look to avoid a government shutdown and pick up the pieces of a 2025 budget plan. Meanwhile, President-elect Donald Trump met with leaders of the International Longshoremen's Association yesterday. In a social media post, Trump expressed his support for the union and criticized automation, saying, quote, "The amount of money saved is nowhere near the distress, hurt, and harm it causes for American workers." Union members, which walked off the job earlier this year, may strike again in January. And the FBI and the Department of Homeland Security say they continue to investigate reports of mysterious drones flying over New Jersey. They've been reported hovering over critical infrastructure, including water reservoirs, electric transmission lines, as well as police departments and military installations. But yesterday, the White House downplayed concerns, saying they appear to be legally operated aircrafts and that the FBI and DHS have yet to corroborate the sightings. That's your Bloomberg Brief. Lisa?
Weird drones. Thank you so much, Yaira. I've got to say, a little concerning. Wouldn't really want to see what's operating.
And not far from where we're sitting right now. This is New Jersey, so what I'd call the upper west side. But Admiral Kirby says the White House nor state, local law enforcement, none of them were able to corroborate this.
No more conspiracy theories, please. Like another thing that people are like, oh, now aliens at the end of 2020. We just don't need it.
I wasn't thinking that. I was thinking more some sort of foreign actor that was hovering over. But let's go to aliens. Let's actually not. Up next, a new tariff warning.
He wants to use tariffs as a major cudgel in bringing people to the negotiating table. I think that would be a real ticket to bring foreign direct investment coming into the United States.
That's coming up next. This is Bloomberg Surveillance. Really? Is that where people's minds go? I'm just curious.
Is that really
it's
been a weird year. Why not aliens?
Okay, all right.
Well,
let's, okay. Meanwhile, people are looking at something other than tariffs, other than aliens, tariffs, and they're looking at markets that haven't really been responding as much to them, trying to bounce after a week of losses. But it's been a strange year, and there has been this real elevation of valuations, getting people nervous, as well as aliens. Under surveillance this morning, a new tariff warning.
My ability to be ready day one to implement President Trump and House Republicans' financial services priorities and regulatory rollback. He wants to use tariffs as a major cudgel in bringing people to the negotiating table. I think that would be a real ticket to bring FDI, that the president talked about yesterday, foreign direct investment, coming into the United States.
Here's the latest. Donald Trump's proposed tariffs leading officials in Canada to weigh export taxes on key commodities shipped into the U.S. Sources saying the move is seen as the last resort by the Canadian government, with taxes set to drive up costs for U.S. consumers, farmers, and businesses. Joining us now is Bloomberg's Mike Shepard. Mike, great to see you. Thank you so much for being with us. I want to just start there. How much have we heard some rumblings of what the tit for tat and the retaliatory tariffs would look like from some of the other countries that the U.S. might be going after?
They haven't gotten to nearly as much detail as what we've heard from Canada already. Earlier this week, in fact, we heard Canadian Prime Minister Justin Trudeau address a business group there in Halifax and warning that retaliatory tariffs, the initial response to any imposed by the U.S., would be immediately on the table. And now we're getting a sense that they would go a few steps further, and that includes export controls and taxes on exports. And this would hit key products coming into the U.S. We're talking about oil, we're talking about uranium, we're talking about potash. These are all real critical inputs. The U.S. imports 4 million barrels of oil per day from Canada, and that would have an immediate effect, especially in the Midwest, in mountain states where a lot of that fuel is refined and sold. Likewise with potash, it's a key input for fertilizer used by farmers across the country. So that would have a big effect. It would not be great for Canada either. And Trudeau's own compatriots are not all aboard with that. Some politicians in Western Canadian provinces are cool to the idea of certainly of Trump imposing tariffs on Canadian goods, but the response, including export taxes, would be much more severe. We do, to your question, Lisa, though, in conversations with officials from other countries, we are not getting to that granular level of detail. They're much more in wait-and-see mode. And while they, as Congressman Hill alluded, see it as sort of an opening shot in negotiations, they don't want to show their cards too early, it would seem.
But sounds like potentially, if Canada were to lean into this idea and to do this, that the Trump administration would probably offer carve-outs for commodities, would they not?
Well, that is what a lot of observers are saying, Anne-Marie, and that's a great question because one of the ways that they could minimize the impact on U.S. consumers and businesses would be to exempt oil and concentrate instead on more finished goods like automobiles and auto parts and things of that nature. But again, it is early, and if they really wanted to have an impact and send a message to Canada about what Trump wants, remember, this is not really about economics. This is about the border. Trump is using the threat of tariffs to try to extract policy concessions when it comes to border enforcement. He's waving this threat against Canada and even more so against Mexico, where he's concerned that the flow of undocumented migrants and fentanyl into this country is causing problems here. And he wants our neighbors to do more, and he's using tariffs to try to get them to do that.
Well, Justin Trudeau is planning a major announcement on border security because of that. So is Trump's negotiating tools working?
Well, maybe in a way, and it's that is certainly one way to put it and look at it, that he has gotten both those countries' attention. In fact, the new Mexican president, Claudia Sheinbaum, has also tried to make some steps of her own. She has reached out also to Donald Trump, just as Justin Trudeau has. You'll remember Trudeau even flew to Mar-a-Lago for a one-on-one dinner, a dinner with Donald Trump, and spend some time with him also on the phone. She has also called Trump and tried to take some steps that she can follow through on when it comes to the border and drug enforcement there. But Trump will be asking for more. And remember, when it comes to the negotiation, as Congressman Hill alluded to, the USMCA deal between the U.S., Canada, and Mexico that Trump forged during his first term, that is up for review in 2026. So this is also a warning shot ahead of that conversation with the two neighbors.
Shep, just big picture here. Is it really that unusual that Canada has a game plan for worst case scenarios? Can we not expect that most countries confronted with tariffs coming from the U.S., that everybody has some sort of idea of what they might do in a tit for tat trade war?
Well, in conversations recently with other major officials from other major U.S. trading partners, one thing that struck me was the detailed level of knowledge they had about their trade flows, including with the U.S. So, yes, they have a pretty good idea of where to hit the U.S. and how to make it hurt. And in fact, when you look at U.S. trade, the last time that we got into it with tariffs in Canada, they went right after things that were distinctly American. Harley-Davidson motorcycles, Kentucky bourbon, Heinz ketchup. So these are the kinds of things that send a message, not only economically, but politically as well, and get the U.S. government and administration's attention.
Mike Shepard, always wonderful to hear from you. Thank you so much for being with us. Bloomberg's Michael Shepard there. And we did get an update on what happened with that vote with French Hill on the Hill. Anne-Marie, what's the latest?
He got the endorsement from the steering committee, so he is ready to go in terms of getting the gavel when it comes to the very powerful House Financial Services Committee. And if you read a lot of the reporting about what went on behind closed doors, it really was a fight between 3 or 4 individuals, and he was able to get it on the second round.
At a point when he would be the first, I believe, chair of the House Financial Services Committee in quite a while who actually has run a bank.
He's run a bank, yeah, that's right. He's also the individual that's been the most outspoken about regulation and when it comes to the crypto industry, really warming to the crypto industry. So those individuals, I'm sure, are very happy to see him get that chair.
Well, it'll be interesting to talk with him going forward about what some of his plans are. Coming up, we'll be talking about some of the increased activity that is expected in the banking sphere. Jason Thomas of Carlyle on the M&A outlook for 2025 at a time some people have argued maybe this has to do with rate cuts, maybe not. We'll discuss. This is Bloomberg. Ending the week with a positive note after what could be the first week of losses in about a month. We are 2 hours away from the cash open. Let's get to your morning movers with Manus Karania. Good morning, Manus.
Lisa, good morning to you. When your AI sales rocking up by 65%, that's a powerful signal for Broadcom. When you tell the market the addressable market is going to be 60 to 90 billion by 2027, that's when you begin to grasp the magnitude of what AI chip delivery is all about. The rest of their business, not as powerful. The semiconductor size of their business, the regular semiconductors, up 10%. These guys have got an EBITDA margin of 66%, and they've hiked the dividend by 11%. What's not to love about Broadcom this morning? PayPal rolled it over. Well, if you're not part of the PayPal mafia in the Trump cabinet, there's always, you can look back at the stock. Wolf upgrades the stock to outperform. Potential upside, $107. This is the largest digital wallet outside China. 220 million active users on this wallet. So it is about monetizing and squeezing that. Now, RH, or Restoration Hardware, as I used to know, but anyway, letter from the CEO. This is the worst housing market in decades, and yet they squeeze out a 24% uplift in demand in November, a 30% uplift in demand so far in this month. This is the personification of the wealth effect in the United States of America. They're raising the guidance. This is a gutsy call. We're not going to be impacted by tariffs coming from China. So that's what they're saying to the market, and also get ready for a pretty spectacular curtain raiser. I can tell you this, I don't think I'm their typical customer. You walk into that store and it's, are you ready to buy the whole room, sir? Not the sofa.
Manis, thank you. And we look forward to your next review of Restoration Hardware. Under surveillance this morning, the Wall Street Journal reporting that President-elect Trump's transition team is looking at ways to shrink or consolidate bank regulators, including potentially abolishing the FDIC. AMH, how feasible is this?
So it's not feasible unless you get Congress on board. What I find very interesting is that you have a bunch of some of these officials. They're trying to find ways, and part of the Trump transition team, alongside Doge, trying to find ways where they can cut some of the fat in spending, and asking whether Trump could abolish the FDIC, which gives you pause because, one, not only do you need congressional support, but the banking world is just giddy about Trump world coming in and easing regulations. But what happens if you were to get rid of the FDIC? It's considered sacrosanct. Could you actually see even maybe a run on banks? So this may be a bridge too far, and not sure Congress would go along with it.
It does make for some headlines that get the euphoria to continue. Meanwhile, Amazon donating $1 million to Trump's inaugural fund after, of course, we heard from Meta. A spokesperson saying they'll also live stream the inauguration as an in-kind donation. Bezos is set to meet with Trump next week. He has a range of business interests that hold federal contracts. And of course, everyone is eyeing Elon Musk, Danny, and saying, can I be your first buddy? Maybe just second buddy.
Can my stock also be up 70% since the election? That'd be nice. As Ed Mills from Raymond James put it yesterday, this is getting a seat at the table. And I think it's also interesting, as you lay out, that Bezos isn't just giving the money via Amazon. He's going to be meeting with Trump. And we know Trump often listens to the person who was last in the room with him. It's not just Bezos. Sundar Pichai, who apparently was at Mar-a-Lago on Thursday, according to the information. Zuckerberg dined with Trump after the election win. These are people who are trying to get their ear. And for people like Amazon companies, it's important. I mean, we'll remember there was a lot of back and forth in the first Trump administration. He basically called the U.S. Post Service their delivery boy and launched an investigation into some of the prices they were doing. So Bezos and Amazon probably want to avoid that this time around.
We also are hearing some response from other countries, as we were talking about with Shep. Canada weighing the use of export taxes on the United States and commodities, including oil and uranium, as retaliation against Trump's expected tariffs. Sources telling us here at Bloomberg those export levies would be a last resort. Retaliatory tariffs on American goods are likely to come first. Anne-Marie, everyone's trying to position ahead of what could be a tumultuous 2025.
And you already see Trump almost renegotiating USMCA before 2026 with both these partners, Canada and Mexico. But when it comes to Canada and these commodities, Canada is by far the largest external supplier of oil into the United States. So if they were to go ahead of this, I mean the Trump transition team in terms of this massive walls going up with Canada, you have to think there's going to be massive carve-outs as well.
In the meantime, people lining up for the banking side of things. Let's turn to M&A. Investors expecting a bang-up 2025 thanks to President-elect Trump's policy proposals, as well as FTC pick Andrew Ferguson. Jason Thomas of Carlyle sharing those expectations, writing this: When coupled with the resolution of election-related uncertainty and prospective policy changes, the fall in finance costs should lead to a dramatic pickup in M&A activity in 2025. Jason Thomas of Carlyle joining us now from our D.C. studio. Jason, thank you so much for being with us. Happy holidays. We're rolling that out. I do want to get your take on the M&A boom that everyone is saying is going to be in 2025. How much is because of policy changes, and how much is because of an interest rate backdrop that looks potentially very different?
Well, it's hard to ascribe exact proportions, but I think the important thing about the rate outlook is that for the last 2 years, there's been very strong expectations among market participants that rates would be much lower in 12 months' time, in 18 months' time. And I think that led a lot of sales processes to be postponed. This idea, let's not sell today, let's wait for 12 months when rates will be 200 basis points lower. Prospective buyers will have a much easier time obtaining finance at cheaper rates. They'll be able to pay more for this asset. And so now I think we're finally at a point where there's much more symmetry in terms of the expectation for rates. Not only today do you have a Fed that certainly is going to cut next week, but how many more cuts are really coming? I think that there's some strong signals when you look at inflation that policy is currently a lot closer to neutral than it is restrictive. So, maybe 2 more cuts in 2025. But that could very easily be offset by significant spread widening over that period. If you look at credit spreads today, we're talking about the tightest levels since May of 2007. So I think that rather than the idea of postponing sales processes or postponing acquisitions for better financing costs in the future, there's a sense that acquirers, sellers need to act now while conditions are as favorable as they are.
Jason, this is fascinating. It speaks to not necessarily rates going lower or higher, but stability being the most important ingredient to understanding why someone would pull the trigger now versus wait a bit longer in order to have a transaction. If rates stabilize at this level, though, Jason, do some of the acquirees have to accept lower prices than when they were evaluated in pre-pandemic times, where the base understanding of rates was vastly lower?
Yeah, I think we're going to go through a very interesting period of price discovery. So first, though, I think it's worth noting, if you look at single B effective yields today, they're only 50 basis points above where they were in March of 2022 before the Fed first hiked rates. So this spread compression has been quite dramatic and has offset much of the increase in base rates. So I think that, again, just appreciating that the scale of spread compression is very important for these pricing discussions. Secondly, I do think most of the transaction volumes are going to involve more seasoned assets that were entered into in 2018, 2019, pre-pandemic. I also think it'll be a lot of broad sectors of the economy where I think that there is these genuine questions about where valuations are ultimately going to settle out in this world of very different finance costs relative to 2021 expectations, is in sectors like technology, where you had extraordinarily high multiples for subscription-based software, digital applications, some medical technology. I think those are areas where, again, this may be a 2-year period before people really feel comfortable having a sense of where the valuations are going to stabilize. But for much of the rest of the economy, I think that the deal volume growth is going to be, I think, really surprising people. I mean, if you scale M&A activity relative to the size of the economy or relative to the price level, we're still down about 42% from long-term averages. So this really could be very meaningful growth from 2024 levels.
So deal activity comes back, Jason. But does the IPO market, because this has been a venue for exits that has been really challenging for GPs, this idea that unless you have a big cap tech company that does something with AI, it won't be treated well in this public market. Do the animal spirits, does M&A coming back also reinvigorate the idea of being able to exit some of these down cap companies into public markets?
I do. So when you look at M&A, if you look at the IPO market, the reopening of the IPO market, of course the underwriters have to set a target to try to generate a pop for those IPO investors. Historically, 8 to 20% trade up in the first week. The 2021 IPOs performed so poorly in secondary market trading over the subsequent 2 years. I think peak to trough down an average of about 70%. So these IPO anchor investors, not much appetite. So the IPO underwriters had to give progressively lower guidance for sellers, for sponsors. I think that's changed quite dramatically. We've seen, we've completed 2 IPOs over the second half of 2024, and the price guidance, the price targets was acceptable to us. I think it's acceptable to sponsors, sufficient return, but then also sufficiently low to actually build this very strong book of IPO investors. So again, I think that when you look at what predicts IPO activity, it is the secondary market trading returns of prior IPOs. As more IPOs perform well, I think you're going to have more and more interest from IPO investors.
Jason, I just got to assume this has got to be music to investors into private equity funds' ears. The LPs who've been clamoring for basically the past year saying you need to exit investments because you need to get cash back to us. So it's finally happening. But do you think that changes behavior of investors, of LPs, just having gone through this period of having their cash frozen, of not getting it back? Will it change and have maybe some reticence in how they invest and where they invest?
What I think has been so interesting over the past year is the way that investors increase their allocations to credit, and with good reason. At the end of 2023, broadly syndicated loans were yielding 10 or 11%, private credit 12 or 13%. That's well in excess of most institutional capital pools' target equity returns, which are generally 9% for stock market allocations. So you're getting higher returns, but of course less risk because you're investing in these securities that sit at the top of the capital structure. This is largely what has led to what you could think of this supply-demand imbalance. All of this money in credit seeking in opportunities where the M&A volumes have not been sufficient to generate the net new loan growth to absorb all of that capital. So that's the origin of the spread compression. And that is effectively what has unlocked, in my view, this M&A boom because of the way it's reduced finance costs, the way that the spread compression has, again, more than offset, in many cases, the increase in base rates. So interestingly, it's investors' allocation decisions moving towards credit that has actually planted the seeds for this looming boom in M&A activity in 2025.
Jason, what would be your advice then about Andrew Ferguson to individuals that are looking at, getting involved in the M&A space in 2025?
I think in Washington, I do think there is still going to be some significant scrutiny of mega cap tech acquisitions. I think that it's broadly shared in the policy community that some of the acquisitions made may have dented competition. Instead of having standalone companies like Instagram, for example, or YouTube, the consolidation perhaps was something that, again, if you had a chance to go back and rethink, that there may have been more scrutiny applied to those deals. So I think that there's going to be, again, a change in policy attitudes so that there is a continuation of the scrutiny of mega cap tech, we'll say. But for the rest of the economy, I think you're going to see merger guidelines, attitudes towards business combinations, that are very dramatically shifted relative to the past 2 years, where I think in many cases it was just deep skepticism about virtually any business combination that was proposed or considered.
Jason, before we let you go, just real quickly here, how much could you see this M&A boom be, given the fact that everyone's kind of putting out their proclamations of just how big 2025 could really end up?
Again, I think when you scale dollar volume of M&A activity relative to GDP or relative to the price level, relative to market capitalization, just getting back to longer-term averages would be consistent with a 50 to 75% increase. So again, it's important to appreciate just how depressed activity has been. Again, I think much of this is just this real option of waiting, this sense that We're going to have better financing conditions in 12 months. No sense in acting now. And finally, that has been played out. Now, the time to act is now. The potential for higher rates in 12 months is something that I think every would-be acquirer, every would-be seller has to seriously contemplate today.
Jason Thomas of Carlyle, thank you so much for your time. Have a great weekend. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Elon Musk and the SEC are back at it. Musk posting a letter on X that said the agency has reopened its probe into Neuralink this week, but it did not say what exactly it's investigating. The letter also said the SEC is preparing to take action against Musk regarding the timing and disclosure of his purchase of Twitter stock before acquiring the company in 2022. According to the letter, the agency gave Musk a 48-hour deadline to accept a settlement over the probe or face enforcement action. The SEC declined to comment. Meanwhile, consumers are still going big at Costco, with the retailer reporting better than expected earnings. Membership rose at the retailer, which is known for selling items in bulk at a better value. Plus, it saw a more than 7% rise in comparable sales at stores, while online sales also grew. On the earnings call, executives said furniture has fueled e-commerce sales this holiday season. And YouTube TV customers are in for a surprise. Starting on January 13th, new and existing customers will be charged $82.99 a month, with the company citing the rising cost of content for the change. When YouTube TV launched in 2017, the streamer charged $35 a month, but from there, it got incrementally higher. In 2019, it reached $50, and then last year, it was hiked to $72.99 a month. At this point, you may as well get cable. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. And they say inflation's dead. Up next, the Fed's Trump strategy.
We don't know what the timing and substance of any policy changes will be. We don't guess, we don't speculate, and we don't assume.
That's next. This is Bloomberg. Heading to Wednesday's Fed meeting, under surveillance this morning, the Fed's Trump strategy.
In the near term, the election will have no effects on our policy decisions. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume.
We do, though. Here's the latest. Fed Chair Jay Powell holding back from making predictions about the economic impacts of Trump's policies, emphasizing the need for more clarity. Former New York Fed President Bill Dudley writing in his new column that just dropped across Bloomberg, the Fed can and must at times make assumptions about what politicians will do. When the Trump administration's tariff and deportation policies come into focus, that outlook may become less rosy. Bill Dudley, I'm so pleased to say, joins us now. Bill, thank you so much for being with us. Let's just talk about how a Fed comes up with a dot plot looking into 2025 without making some assumptions about what the policy backdrop is going to look like.
Well, I think they are going to make assumptions. I think they're going to assume that the 2017 tax cuts do get extended. So I think what Powell said at the last press conference, we don't guess, speculate, assume, is actually contradicted by what they actually did in December 2016, when they did include the fiscal policy stimulus that they thought was going to be enacted by the first Trump administration. That was in the forecast. So I think, they have to assume it when it's big, when it's likely, when it's sort of clear what it's going to be, and when it's priced into financial markets. And I think that's true for the extension of the tax cuts. It's not true for tariffs or immigration policy, because it's very uncertain about what those policies actually will be at this point.
Bill, do you think that that's why it's more important to look at, say, tax cuts than some of the other policies that could potentially have contradictory effects on inflation and growth?
I think the real problem on tariffs is you don't know how big they are, how long they're going to last, whether there's going to be retaliation. And on deportations, you just don't know the magnitude or speed of what the program is going to be. And so if you don't know what it's going to be, it's really hard to put it into the forecast in terms of its likely effects.
Well,
so I think the tax cut assumption is going to be in there, but nothing else.
Well, when it comes to tariffs, the September 2018 Teal book talked about the fact that in the first iteration of Trump, they just saw the tariffs as a one-hit threat. Do you agree with that assessment? And Do you think that would still hold today for this FOMC?
I don't think they're making any assumptions on tariffs yet because we just don't really know what the administration is going to do. I think the big difference, though, the tariffs that were done in the first Trump administration were actually relatively small. The total tariff on imports went from 1.5% of imports to 3% of imports during the first Trump administration. We're talking about much bigger numbers now. We're talking about 10, 20%, 60% against China. So the magnitude may be much greater, but we're not really sure. Is this just a threat, or is it actually going to turn out in terms of substance?
So, Bill, what we essentially have is just the incorporation of tax cuts and missing out on two key pillars of Trump's policy going forward, immigration and at the same time tariffs. I know that this is a sacrilegious question, so you'll have to forgive me, but are the dots even useful this time around then?
Well, I think what's the problem with the dots is you're going to have an unusually rosy forecast because it doesn't include some of the more controversial economic policies that could really change the outlook with respect to growth, inflation, and productivity. You know, higher tariffs, deportation is going to be disruptive to the economy. It's going to tend to push inflation up. It's going to push growth down. And that's just not going to be in the forecast.
At this point, Bill, what's your base case for how they're going to sort of telegraph some sort of pause or some sort of adjustment to the process of rate cuts in 2025?
Well, I think it'll be done in a couple of different ways. Number one, the number of rate cuts that they show in 2025 will go down from last time. Last time in September, they had 4 25 basis point rate cuts in 2025. So this time will be 2 or 3. And second, I think Powell will talk about how, inflation is a little bit sticky. The economy is doing really well. You'll probably see some upward revisions of the Fed's estimates of so-called R-star, the neutral rate. So I think all those things together will make it pretty clear that, January is probably going to be a pause. And that's really what's priced into markets. Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
Bill, what's your take? If you were on the FOMC, where would your dot be? What would you be looking for next year, and what the bigger concern is, inflation or weakness?
Well, I think the big place where I would probably diverge from the consensus of the committee is on R-star. Right now, the median estimate of R-star is 2.9%. So the Fed is basically going to show the federal funds rate going to 2.9% in the SEP, not in 2025, but in 2026 and 2027. I'd have a higher R-star, probably something in the order of 3.5%, maybe a little bit higher. So I would not have as much cumulative easing of monetary policies as what the Fed will have.
And that seems to be where the market's at right now, certainly, as well.
Absolutely.
Former New York Fed President Bill Dudley, thank you so much for being with us. And really, that's going to be the key question, Danny, going forward, is just how much do you see a readjustment of what this new reality of a neutral rate really looks like for this Federal Reserve.
And how many tools does the Fed have if they are in this position where they're giving policy, they're giving the dots, and the market's going to look at that and, to Bill's point, say, I think this is a more rosy estimation of what it will actually be because we know you're not incorporating certain things. It kind of limits the ability of the Fed to give policy via communication. If the market's willing to just write it off and say, we have a very different idea of where things are going.
Well, this is why Evercore ISI in a note out this morning is talking about this hawkish cut, because it's going to be a cut, but then it's going to be very dicey and difficult to understand what they do going forward for 2025. And to Bill Dudley's point, that might mean a pause in January.
Yeah, but a hawkish cut and still saying the neutral rate is like 3% or 3.25% might not be so hawkish for a market that's moved well ahead of that. More to Bill Dudley's side of things. Coming up, John Stoltzfus of Oppenheimer with the biggest bullish call out there so far for 2025. Mandeep Singh of Bloomberg Intelligence, Claudia Sahm of New Century Advisors, and Rieder of BlackRock as we look to a yield space with yields higher across the board. This is Bloomberg.
We have to look for the risk of some shock effect coming in that distorts sort of the euphoria that we've been contending with.
I'm not running away from U.S. stocks, right? But the idea is, do you get a broader market in the coming year?
When we head into next year, we could have shocks from either trade or fiscal policy.
Over time, those higher rates start to bite, and I think the Fed will have to capitulate at some point.
It's really important to stay pro-risk, to stay pro-growth. Just recognize that the range of outcomes is going to be wider.
This is Bloomberg Surveillance with Jonathan Verrone, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance as futures climb, led by big tech. Looking ahead to a big week next week possibly the last big week of the year with the Fed's rate decision on Wednesday, capping a year of incredible uncertainty. Right now, futures just marginally higher across the board, led by big tech, as we mentioned before. But I was listening to that intro with all of these people talking about the potential for shock. And Anne-Marie, it's almost as if people want to sound like they could potentially be bearish, but then also keep buying.
Well, this goes to Christopher Harvey's note this morning, and he says equity strategy are bearish. Really, it's fascinating. He says there are shy bulls out there. Some PMs claim to be bearish, but are driven more by the desire to be contrarian than by fundamentals, which is why they're sticking with 7007 for next year.
Which is the reason why it's sort of a race to see who can actually upgrade their forecast for next year the most. We're going to be speaking to the biggest bull on the street coming up. Question about whether they are susceptible to a surprise from the Fed on Wednesday next week, Danny.
And this is the thing. Bank of America was out with a note earlier that basically said the reason that risk assets have done well in 2024, despite all of the uncertainty about all the things popping up, is that central banks started their cutting cycle, that this has been really the key for risk assets continuing to go higher and is presumably going higher in 2025. So if we get something from a Powell that sounds maybe this cutting cycle will get cut short, that could be the thing that disrupts the bulls and the calls for 7,000 next year.
We have seen $480 billion flow into U.S. equities so far this year. It is on track to be an absolute record, with the U.S. dominating all flows that we've seen across the board. I love that Chris Harvey note. I just keep thinking about it. Basically driven by this wish to be contrarian. You understand why they want to be contrarian, though, at a time where there's such an overwhelming consensus.
It's uncomfortable, and you bring it up all the time. The fact when everyone's on one side of the boat, is something wrong when you look at this picture? But research note after research note, looking into 2025, everyone is saying, no, you have to be a part of this rally. It has not stopped yet.
I will say I'm seeing so many more qualifications in research notes to end the year than you usually do. It's like, okay, we'll do really well in 2025. Maybe 2026 we'll get some disruption. Or maybe we'll do well in the first half and then pull back a little bit. Or we think it's going to be 7,000, but hey, our worst case scenario is 2,000 points less than that. There's a lot of qualifying and, making sure if things go wrong, you have your bases covered.
There's going to be a bubble in 2029, but buy in the meantime. Coming up, and not that, John Stoltzfus of Oppenheimer as the rally takes a slight breather, but he has the biggest, boldest call on the street. Claudia Sahm of New Century Advisors on the U.S. economic outlook for 2025. And don't miss this, Rick Rieder of BlackRock looking ahead to that final Fed decision of the year. We begin this hour with stocks higher, investors parsing mixed inflation and labor data, looking ahead to the Fed and next year. John Stoltzfus of Oppenheimer, the most bullish on the street, writing this. Fundamentals suggest to us further upside for equities based on current stateside monetary policy, the resilience in economic growth, business activity, the consumer and job creation evidenced in recent years. We initiate a price target for the S&P 500 by year-end 2025 of, drumroll, 7,100. John joins us now. John, thank you so much for being with us. You were the biggest bull.
Lisa,
you were the biggest bull last year.
I love the drum roll. I thought that was great. We really take this setting the target very seriously. Although we really think the most important part of it is stating what we expect the direction of the markets is going to be. And in this particular case, it really does look like the fundamentals are intact. You've got a business-friendly administration coming into the White House, as well as at least on a marginal basis, Congress, and essentially more business-friendly outlook, it would seem. And then you also have the bond market, which applies discipline. If the Fed, I think, relies a lot on the bond market to make some of its statements related to inflation when it's stickier. And the judgment that it might place, and usually it's the 10-year that provides the signal.
John, I'm looking right now at the upside for the 7,100, and it points to a 16% upside from the time when you initiated this. You were the biggest bull last year, and it wasn't bullish enough. And it raises this question, why stop at 16%? Why not 25%? What about doubling?
Well, we're not gunslingers. The old thing in the days of in the 1960s and the 70s, they used to call the mega bulls at that time gunslingers. We're not looking for a perfect world, peace on earth, or anything that would be unrealistic based on history of the last millennium. But we would have to say we are looking for a Fed that remains very sensitive in terms of the economy, both related to both sides of its dual mandate in terms of the quality of the economy with inflation in check, and yet not pushing unemployment to levels that would be concerning. And then business, the consumers, job growth, even if you see some slowing or at times some guidance that is rather cautious, all in all looks pretty good to us. We think it's a continuation of what we've seen, but not necessarily at the pace of picking up another 20%. But we'd be glad to ratchet this target higher if the S&P would close at 7,100. We'd at least consider ratcheting it higher.
Fair enough, John. I just wonder, though, how do clients feel about this? Have you gotten any pushback of people who have said, John, you're bullish, everybody's bullish, I'm worried everybody's bullish?
Danny, I think they hear from me very often that if one thing that does concern me is that so many bears have capitulated and are on our side of the boat. But that said, as you know, I've been in this business for 41 years, so I came in to this business during the second term of Paul Volcker, which was, a scenario of much higher interest rates, much higher inflation, and all the drama that developed through that. So I bring a certain amount of context. That doesn't mean our calls are always right. But our clients over the last 12 years that I've been with Oppenheimer have heard me speak a lot. They have a lot of access at Oppenheimer to our viewpoints and our publications and client events. People are remarkably calm, though they're very realistic. They're well diversified. They know what they own. They know why they own it. And they have right-sized expectations of how their assets are going to perform as the economy works things out and as the Fed directs the economy towards its 2% target.
So, John, as we head into another year by your accounts, that's going to be a good one for equities. Does leadership in 2025 look different than 24?
Leadership, we do expect a continuation of the broadening, but very much in some ways, the market has been sort of like a python digesting things. So you watch the digestive process as it moves forward. You get a broadening, then a narrowing, broadening, and a narrowing. And so we have seen since the lows of October 2023, the market has had periods where it broadens, it goes through, it gives, it share. You see the Mag 7 share the stage in terms of performance for a period. With other sectors, you get the other 10 sectors, you'll see them perform to some extent. Mostly 9 of them, energy really hasn't been a great participant in that area. But what we're seeing is that it even goes to market capitalization, style, growth versus value, though growth has been favored all year. There are periods where all of a sudden you'll get some growthier value, will have a good bid placed on it. In addition to that, other than style and market capitalizations, cyclicals continue to outperform defensives for the most part.
John, when it comes to your research, we all know you're a bull, but you do say you think the legs are strong enough to climb this proverbial wall of worry into and through 2025. Can we talk about, though, what are some of the worries you are concerned with?
Well, I think some of the worries are just what we've heard from guests on your show earlier this morning. The question is, will the administration use tariffs as a blunt instrument, or will it use it as a negotiating tool in a world in which the U.S. is the buyer of choice? On Wall Street, if we were going to give a Wall Street definition to the U.S. economy, we're buyers in size as consumers. And so that in itself, I think, offers a negotiation strength for the administration in just trying to remove some unfairness within the global competitive landscape, as well as look to bring some businesses back that are important for national defense and healthcare, for example, I think are important. But I don't think we're looking at a picture that's as dramatic as many expect. I also think the geopolitical risk, of course, remains significant. Sociological concerns, within the United States, as we just saw, related to the killing of the head of a large insurance company. All of that has a sentiment of value that's important to consider. But related to the economy, I think the most important is that business is doing what it needs to do. The consumer is doing at a slower pace, but showing to be a consumer that is more sophisticated than ever before, probably because of the financial media. I mean, Bloomberg educates people, and so do some of its competitors as well, and that makes a difference.
Well, thank you so much, John. Everyone around this table appreciates that. Your first concern there in that wall of worry was tariffs. I know you also love this genuine potential for AI. So do you think AI can trump some of Trump's policies?
I think, Anne-Marie, that when it comes to AI, I think the value of AI is what it does for the other 9 sectors other than technology, to increase efficiencies and operations, and for the consumer to increase efficiencies in their dealing with the companies they buy services and products for. And all that to us looks like contributory to a more economic strength, better opportunity in terms of new types of labor, and we're in the early innings of it. So we're believers in AI. We're all the moonshot stuff. We'll wait to see how all that works out. But on a day-to-day basis, we think managements that are suitably placed to grow their companies and benefit their shareholders, their customers, and their employees are investing in AI, and we think it's progress, and we think it's watershed quality progress that probably is parallel to where the automobile was in the 20th century after Henry Ford had mechanized the assembly line and brought down the price and increased the quality broadly. It changed the way people lived.
John Stoltzfus of Oppenheimer, thank you so much for being with us, and happy holidays. We'll see you on the other side. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. The Trump transition team wants to drop a car crash reporting requirement for autonomous vehicles. That's according to Reuters. This would particularly benefit Elon Musk's Tesla, which has reported more than 1,500 crashes to federal safety regulators under the program, according to the report. The move could hinder the government's ability to investigate and regulate the safety of vehicles with automated driving systems. Meanwhile, Donald Trump's team could be looking to make banking regulation a thing of the past. The Wall Street Journal reporting that officials from Trump's Department of Government Efficiency have talked about shrinking, merging, or even eliminating agencies like the FDIC. Bank executives are hopeful the Trump administration will ease regulations on capital requirements and consumer protections, but any proposal to get rid of an agency would still need congressional approval. And the Container Store is preparing to file for Chapter 11 bankruptcy in the coming weeks. The move follows mounting losses and escalating liquidity issues at the retailer, according to people familiar. The company had been in talks with lenders to provide capital for growth, but have pivoted to focus on restructuring efforts. The Container Store operates 103 stores across the U.S. and holds nearly $230 million in long-term debt. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Container Store. I don't understand it. I know that you understand it, but I kind of felt like if you wanted to organize your stuff, why buy more stuff? I don't understand.
But you know what it feels like when you were a kid and you did back to school shopping and you got like cool notebooks and that's like the Container Store is the adult version of that for me. Like, ooh, pretty things to put in the house, to put other things in.
You don't Marie Kondo your closets and your
throw
kitchen?
Things out. I don't actually try to buy new plastic things. Well, anyway, I digress.
Too logical, Lisa.
Up next, the morning calls. Plus, Mandeep Singh on Bloomberg Intelligence as Broadcom soars on anticipated AI demand. That's coming up next. Right now, Broadcom shares up almost 17%. This is Bloomberg. Welcome back. back. This is Bloomberg Surveillance with stocks higher ahead of the open. Futures just up about 0.4% on the S&P. You can see across the board pretty slow action, although the euro bouncing after yesterday's tumult, I should say, after the ECB rate decision. 10-year yields higher again, crossing that 4.34% threshold in the United States. Time now for the morning calls. First up, Barclays upgrading Norwegian Cruise Line to overweight, citing confidence in underlying demand. Next up, JP Morgan downgrading Toll Brothers to neutral, expecting a less supportive backdrop for the home builder next year. And finally, KeyBank upgrading Salesforce to overweight, saying it is optimistic about the company's AI platform, Agentforce. So let's stick with AI, as it's going to be a transformative force similar to the creation of the automobile, as we were just hearing about. Broadcom rallying after predicting a boom in demand for AI chips. The chip supplier for Apple and other big tech companies saying AI products will gain 65% in the first quarter of 2025. Joining us now to discuss is the one and only Mandeep Singh of Bloomberg Intelligence, who always provides us with incredible insights. What did Broadcom get right in its guidance, given the fact that its numbers did not necessarily outperform to such a big degree?
Yeah, so you're right, the numbers were in line, but what they gave us was the runway in this market with their existing customers. So the three hyperscalers, which are their customers, Google, Meta, and I think it's ByteDance as the third one, their addressable market is 15 to 20 billion. They said that addressable market is going to expand to 60 to 90 billion just from these hyperscalers. That's huge. And think about it. The two of these customers are also customers of NVIDIA. When they say hyperscaler exposure is 45%, they're counting Google and Meta as customers. So the fact that Broadcom is so optimistic about the ramp up of these customers on their platform, it just goes to show that if Google is building a 1 million cluster of their TPUs, they're using Broadcom, and probably they are moving away from NVIDIA to an extent, but they could use both. And that's the real takeaway here.
That's where I wanted to go. How much is Broadcom an alternative to NVIDIA? How much is it parallel? How much is it being used by the likes of Apple to diversify the sources of their chips so that they're not so dependent on one company that keeps jacking up the prices for them?
Yeah, so think of the biggest AI cluster right now. It's about 100,000 GPUs. What Broadcom said last night is we will have a 1 million TPU cluster or a GPU cluster over the next 3 years. Now, whether it's GPUs or it can be any ASIC, which is a TPU or any other custom chip, Broadcom is betting the latter because that benefits their business. GPU is more of a standardized chip for AI. Broadcom is saying every hyperscaler will build their own custom chip. And that's where, you don't need to buy everything from NVIDIA, networking, GPU. You can customize the workload and buy the chip from Broadcom and then customize it the way you want. And I think that's a big bet they're making with the hyperscalers. Remember, the 60 to 90 billion is just for the hyperscalers. They're not talking about the entire AI market. They're just saying these hyperscalers are going to spend 60 to 90 billion in the next 3 years.
Well, maybe not for AI, but some of the other chip components, you've seen the likes of Apple try to bring that in-house and away from Broadcom's, things like their Bluetooth and their Wi-Fi. What does that do to a Broadcom? Do they start to move away from some of the more legacy businesses as tech players bring those internally?
Yeah, so that's always the risk for Broadcom. Right now, Apple is their largest customer, 20% revenue exposure, but that's more on the iPhone side. Apple is also ramping up on the data center side. In fact, they called out 2 new potential customers, and Apple and OpenAI were 2 of them. So OpenAI could make their own chips. And that's where Apple moving away is not that big of a threat because they will end up ramping on the data center side. And so I think the custom chip is a real opportunity, and Broadcom is the player that's positioned the best.
Earlier this year, though, there were concerns in one of their earnings report about too much revenue coming from China. Have they been able to diversify more?
So that's a real risk. I mean, nobody knows what will happen when it comes to tariffs and how these companies get impacted. I said ByteDance was one of their existing 3 hyperscalers. I mean, imagine what could go wrong in that situation. So clearly that is a risk. But I think that risk is for NVIDIA as well as for, some of the other companies.
But you mentioned ByteDance. They're literally working with ByteDance. ByteDance owns TikTok, and that might be banned in the United States after January. So is Broadcom, would you say, the most vulnerable when it comes to these semiconductors?
I mean, given the size of their AI revenue is around $12.5 billion right now, and you could say maybe 25% revenue exposure to ByteDance. So they have a sizable exposure, but I think Apple has the toughest challenge when it comes to China. So yes, we may think Broadcom is exposed as well, but I think there are a number of other players that are exposed to that situation.
Mandeep, one of the other risks that people love to talk about because they want to be contrarians or for whatever reason is the idea that they're really exposed to the hyperscalers and they might slow down their spending. It was interesting to listen to the CEO of Broadcom talk about the next 3 years and the potential of that. Do you think that put to bed some of the concerns of the spending petering out?
Absolutely, and if anything, CapEx, they said CapEx could grow up 35 to 40%. Broadcom said they will exceed that 35 to 40% growth ramp in the CapEx of the hyperscaler. So if anything, what they're telling us is Broadcom will grow faster than potentially NVIDIA at this point, given NVIDIA has a larger base. But the fact that he's so confident that they'll grow faster than 35 to 40%, it just tells you how much visibility they have in terms of the CapEx ramp from the hyperscalers.
Mandeep, how much has the world of AI shifted in 2024 when it comes to who the leaders are and who the leaders are set up to be in 2025 at a time where you see Broadcom making these inroads, you see NVIDIA slowing down, and then you see a couple of the players really not put in the performance that a lot of people were hoping for?
Yeah, I mean, look at the shift. Intel's, CEO having to leave. So clearly there are some market share shifts that are happening, and that will happen. I mean, some of these new applications that will be built on generative AI models will be very disruptive to existing businesses. But look, I think everyone was worried about some CapEx digestion. I don't think we are getting that. I mean, these companies will continue to invest in building bigger clusters, and the scaling laws are still applicable. So right now, we are still in that, second, third innings when it comes to Gen AI.
Mandeep Singh, thank you so much, as always, for taking the time. Mandeep Singh of Bloomberg Intelligence. Just noting that a lot of people looking at artificial intelligence to interpret Fed speak, and I got this from Deutsche Bank. We asked our AI tool to grade the degree of hawkishness of the ECB press conference, and they came out that AI finds no signal beneath the surface consistent with an imminent 50 basis point cut. This is the new thing. It's sort of Fed speak reader in ChatGPT.
Yeah, but we all could have told you that. I mean, how great are these insights? We all could have listened to Lagarde. I guess it saves you time of not having to do that. But I want something real and unique and something you couldn't have just gotten, maybe taking signals from, I don't know, her brooch or something
Exactly.
like that.
That's what I was going to say. Her brooch sometimes signals whether or not she's going to be dovish or hawkish, and I'm not sure AI is able to glean into that.
You can add that to your models for AI. Coming up next on her models for AI and other things, Claudia Sahm of New Century Advisors with real insights into what to look for in next week's Fed meeting, as well as, of course, the dots. And Rieder of BlackRock, as we do see yields inflecting higher past a couple of key technical levels. How much does this signal the path of least resistance is higher, not lower, or does it signal that it's in the end of the year and things are messy? This is Bloomberg. Futures looking rosy on this Friday the 13th. After a week of losses, can they climb out? We're seeing those gains escalate heading into the open, up 0.4%. NASDAQ futures up now almost 0.9%, 1 hour away from the cash open. Let's get some of the specific components with your morning movers. Here is Manus Krane. Manus.
Lisa, good morning. Look, one big alpha in sentiment this morning is coming from Broadcom. When you have, as Mandy just said to you, a confidence in the visibility, a confidence in the CapEx visibility, that is what Broadcom is telling the market this morning. Not only do they see their AI products up by 65% in this quarter, but it's about the guidance through to 2025, a market, an addressable market of somewhere between $60 to $90 billion. So for every product they deliver, they're really chasing into a growth market. Margins of 66%, dividend uplift of 11%. This is a monster announcement from Broadcom, to the extent that Bank of America shift the gears on the stock price up to $250 from $215. It's all about the AI opportunity. Snapshot of PayPal. This is what we got for you. There are 220 million. This is a staggering stat. The biggest wallet outside of China sits within the PayPal family. How do you monetize that? How do you upgrade that? How do you take the journey from a 4% growth rate this year to mid to high single digits next year? That's what they want to know from the investor day. I'll leave you with a snapshot of RH. This is, despite the worst, in their words, the worst housing market in decades. You've got a 24% ramp in demand in November. I wasn't part of it. December, up 30% month to date. And not only that, but they give a gutsy guidance. How many CEOs out there can come out and say, doesn't matter what the tariffs are coming from China. We are diversified. We've removed ourselves from that fray. We've got a supply chain that's intact. This is a gutsy guidance from RH. Great kit, by the way. Lisa.
Thank you so much, Manus. Have a wonderful weekend. Markets digesting mixed data ahead of the final Fed meeting of the year. Bloomberg Economics expecting this week's CPI and PPI data will result in soft core PCE, opening the door for more easing. Claudia Sahm of New Century Advisors writing this. Markets greatly overestimated the number of Fed cuts this year, but not the Fed. They were more cautious about disinflation in the second half of 2023. Caution will be a Fed buzzword for 2025, but it's evergreen for the Fed. Claudia joins us now, and thank you so much for being with us. Happy holidays. I want to start there, Claudia, the idea of what does caution mean at a time where, for some people, it means potentially even pause for the entire first half of 2025.
Right. So at the Fed, a big piece of the caution is they are, to their core, data-driven in their monetary policy. And we know, after having watched the data very carefully with them all year, the data are messy. And so that is part of, they want to see the good news when we see the disinflation, like we did a lot of disinflation in the second half of last year, but they don't necessarily want to extrapolate that good news. So I think we rounded out the inflation data for this year in an okay place, right? We saw numbers that were okay, particularly after we brought in the producer price index, but they're not great. And so that's where the Fed they will have done a percentage point of cuts this year if they go forward with the 25 basis points next week. That's not nothing, right? But they're going to then take a break, see how the data lays, see if this inflation, the good news, continues, and then keep going. But they're not in a hurry, and I think that is a stance that has largely served them well.
Claudia, do you think that it was a mistake in retrospect, or that there will be a reversal of Fed Chair Jay Powell talking about how he would not welcome any further weakening in the labor market?
Oh, no, I think this is still a dual mandate Fed, as they should be. That is the law. I think that's one thing that makes the Fed very hard to read. Like, if you look back at their projections from a year ago, and as I'd said, they were pretty close really on the cuts that they did this year. They actually did a little bit more than they had expected. And yet their forecasts and other pieces were had some big misses. And so there's not a simple reaction function. Like, the Fed's job with the dual mandate of stable prices and maximum employment, that is a very tricky job. And so they, in addition to being cautious, they are known to, and have been, and we saw it this year, nimble in their decision making. And they have shifted off at times, concerns with the labor market and concerns with inflation. And that, I think, is a theme we will absolutely see going forward into next year, because inflation, we've made a lot of progress, and the labor market has cooled off a lot. So that is going to keep coming back as a theme.
Well, the shifts might need to happen even more, Claudia, just because we don't know what type of fiscal policy we're going to be getting, or at least the details of it. What does that mean for the summary of economic projections? This time around, how useful is it to look at for a guide of 2025 if, in the words of Powell, they don't assume?
Right, so I think the summary of economic projections is going to be of limited use. I mean, I think they're generally of limited use, but it is unlikely that Fed officials are going to build in their guesses on fiscal policy. And so that means it's more of a read of, after the inflation data we've had, and there's been a lot of discussion about, is disinflation stalling out? Like, are we in some problem space right now? And they're probably going to pencil in a little bit less of interest rate cuts next year. And that's going to be reflective of the data that we have in hand right now. And it is not going to be telling us what they think about the fiscal policy. And honestly, like, the 2025 forecast probably can get away with it. Right? It's going to take some time. We're going to get a real blast of words about fiscal policy and some initial reactions. But by the time it feeds into the economy, which is where then the Fed is reacting to it, that's going to take a while. So, like, especially the out years of the projections that we'll get next week, they're really not worth the electronic paper they're printed on.
Well, we heard from Bill Dudley earlier, of course, the former president of the New York Fed, a Bloomberg contributor. He has an opinion piece out today, joined us on the show, and he said, you know what, Powell might actually have to walk back that assertion that we don't assume, especially when it comes to tax policy. Could that be one avenue where you could see a little bit more of looser language, maybe in the press conference from Powell?
I don't think he has to walk it back. There is a real logic for the Fed not to get in the business of the putting in the fiscal policy. And frankly, if you go back and you read the forecasts and the details of them that they put together at the same time as Trump was getting ready to start his first term, they had the staff forecast had very loose assumptions about kind of placeholders almost of fiscal policy. And I think in a way that this time, because the tax cuts, a lot of it's extending and we don't know what it's going to be added on. And the tariffs are a real wild card, both in what the U.S. does and what other countries do. Like, it's just like, why? It's like it would be the Fed creating noise. If they're putting in these assumptions and guesswork, and then they're front running the administration that hasn't even gotten to work yet. So I disagree with Bill on this one. I think Powell's going to kind of put his foot down and tell people don't put it in. We don't want it in this forecast.
Claudia Sahm of New Century Advisors, thank you so much for being with us. Happy holidays and have a wonderful weekend. Rick Rieder of BlackRock, looking ahead to next year's Fed outlook, writing this. Several crucial factors for the U.S. economy appear quite favorable and constant in the years to come, although there are also a number of uncertainties that cloud the inflation outlook, as well as complicate the Fed's rate cut recalibrations. Rick joins us now. Thank you so much for being here. It's been too long.
Thanks for having me.
Rick, I'd like to start with this question of how much Fed policy drives what you find attractive right now at a time where the progress with disinflation seems to be at least calming down.
It's a great question. So I'm going to try and give an answer that's more clear than what you just read there. I was thinking through, I'm not sure where I wrote that in, but listen, I think part of what I was describing, listen, the economy's in good shape. Economy, I mean, you look at, we're going to get retail sales. I think it's going to be a pretty good number. You look at the Thanksgiving sales, the consumer's in good shape. CapEx, we talked about Broadcom this morning. The investment that's going into AI, the CapEx, the R&D spend is pretty significant. So you got an economy that's operating at a good level. And as you said, inflation is, if anything, bending up a little bit, and so much of the progress. So now, what does the Fed do? Listen, I think, and I agree with the way Claudia Sahm described it, I think they got to go in December, and you're getting, we've been pretty adamant about get the funds rate to 4, get it to 4 because it's too restrictive and you're hurting lower income people when you're up at 5 3/8 and in those levels. Now you're there. I think you step back and say, let's see where we are, interpret the data, and I think it was a great question about, policy is going to change. What does strategic decoupling look like? What does deglobalization, what does tariff look like? What is the stimulus you put into the economy through deregulation? Boy, the range of outcome for GDP is pretty significant. I think your base case, economy is going to be in good shape. Economy is, if anything, U.S. economy, different paradigm globally, but U.S. economy is in pretty good shape.
It raises this question of what's the bigger risk, credit risk or rate risk? It sounds like credit risk is not the biggest concern simply because if things are so great, well, credit looks good. At the same time, spreads are pretty tight, and you have to worry that maybe people are overestimating what the effect of some of these policies could be. So how do you sort of judge those two issues?
So I did a presentation yesterday where I showed that for the first time in decades, so the risk-free rate is more volatile than the risky rate or spread sector. It's actually a remarkable point in time. And so normally when we build any asset, whether it's equity, debt, you think about what's my risk-free, that's your constant, and then you build your variables on top of it. The variables are actually much more stable today than the risk-free rate, particularly as you go out the yield curve. Listen, I think the front end of the curve is pretty well pinned. I think the Fed sits there for a while. Could you soften up a little bit from here? Maybe. But I think you're pricing in, a Fed that's going to, sit here for a little bit, try and get another couple of cuts done next year. The long end of the curve has got some of the term, first of all, term premium in the back end isn't enough at this point. And so, listen, I think you got some volatility out in the longer end that, around the economy that's in pretty good shape.
What would it look like to have enough term premium in it? How far away are we from fair value?
So, it's a tough question. I mean, one of the things that's interesting, so people talk about we're going to put on a curve steepener in the back end of the curve. The technicals in the back end are actually pretty good because there's so much sitting on the Fed's balance sheet. So the net float that's in the system, including when you take what pensions, life insurance companies own a lot of long end. So, where would you buy it? My view today is like there's not a big tactical, let's put on the steepener trade. I just feel like I can clip a ton of income in the front to the belly of the curve. We build this ETF called BINC where we're creating 6.25%, 6.5% yield. You can use reasonable quality assets, high yield, securitized, stay in the front of the belly and let other thrill seekers figure out where to go on the back end because it's just like I just don't find it an asset. So think about it. If you have a portfolio, you can own long durated assets. You can own equities, or you can own the long end of the yield curve with not a lot of term premium, and the equity market's throwing off 18% ROE, growth of book value. So and a technology innovation framework that's pretty incredible. So it's like, when I pick my tools in the markets, long end interest rates is not one that I say, whew, let's stop at that one.
Well, there have been a lot of people who don't even want to get close to being a thrill seeker and have remained in cash-like instruments and have remained in those types of funds, even though there's been calls so often this year that there's reinvestment risk. You got to get out of cash. You're going to miss this move in yields. And that hasn't played out. Mm-hmm. Does 2025 change that?
So agree and somewhat disagree in that. Look at the high yield market this year. So the high yield market, is going to bang out 8.5, 9, 9.5, depending on where you are return. Pretty good. Spread markets have done really well. If you're staying in the front end, so this is the incredible dichotomy. Long end of the yield curve this year, negative return, but the 1 to 3 years it's actually been pretty good. So listen, I think one of the things that's pretty historic about where we are today, at some point, the economy is going to moderate. I think we're a few months from that. But you can see a dynamic as you get to the back half of this year that you start to see some, particularly if you got tariffs, you would get some global slowdown. The real rate of return you're locking in today, this point about, gosh, you can build a portfolio, use some high yield, get a 6.5 yield. If inflation's running, let's say inflation bends up a little bit and we're running 2.5 to 3, that's still pretty darn attractive. And so this idea, does cash deserve a seat at the table? Definitely. It's a great risk mitigant. But gosh, if I can lock in these real rates, those real rates, every time you've had real rates in history that have reached this sort of level, if you took a 1 to 3 year time horizon, the returns are spectacular because at some point, Fed's got to get that real rate down because you can't create enough velocity in the system until you get it there.
Rick, you talked about the range of GDP expectations we could see with changing policy in Washington, D.C., but then you just mentioned inflation. How concerned about some of these policies might mean stickier inflation that lasts and is pervasive through 2025?
So, listen, I think at the margin, when we run our data and we look at where is inflation trending, we're pretty constant in terms of where we are. We've got core PCE next year at about 2.5, 2.6. CPI is a little higher than that because of some of the component dynamics to it. We think it's pretty constant. My sense is you're not going to see dramatic tariffs, a la some of the things that get thrown out in terms of negotiation. But I think you have to assume, at least today, that the trend is a bit more inflation into your calculus. The one thing that I think is extraordinary, though, and I think people don't spend enough time thinking through, if you think about all this investment in AI, and you think about the productivity enhancement that's going to come through AI, we could talk about job replacement. We could talk about, the ability for, so many functions that reduce. You can really have inflation that ticks up, incredible spend on data center, on energy, on cooling, ticks up in tariffs, and you can get a bit more in terms of inflation. You get this one-time adjustment up in price. And I actually think you're going to start to see it move the other way pretty significantly. The timing of that's pretty hard. Is it 9 months from now or 2 years from now? But I'm pretty convinced that's coming.
What gives you the conviction, though, that it won't be the blanket tariffs?
So I'd say a couple of things. One, the president has run under this dynamic of we're going to bring inflation down. There's a couple of things that happen when you put pervasive global tariffs on. One, they're very hard to implement. Two, there is a tangible growth dynamic on the other side of that. Once you create that sort of abrogation of global trade, you get a near-term slowdown that can be pretty significant. We look at industrial production and how much that can come off. So, gosh, I think my sense is you'll get a series of negotiations. You'll get some bilateral tariffs, depending on who negotiates where in the world. China is clearly a place you would think you're going to get some more significant tariffs. But boy, the impact of doing that globally, really has an impact on the U.S. I did an analysis yesterday of Mexico, Canada, and cars. You think about the incredible traffic back and forth in vehicles, trucking, petroleum, refined fuels. Like, boy, oh boy, if you cut that off of any significant magnitude, the impact it has on growth and inflation can be significant.
Rick Rieder, you're going to be sticking with us, which I'm very happy to say. Rick Rieder of BlackRock, hanging around right now. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Russia launched a massive airstrike in Ukraine this morning in what Kyiv described as one of the largest attacks on its power infrastructure since the war started. Ukraine's President Zelensky saying on Telegram that Moscow fired almost 200 drones and more than 90 missiles, 81 of which were intercepted. According to the International Atomic Energy Agency, the attack forced Ukraine to reduce output at 5 of its 9 nuclear reactors. Meanwhile, President-elect Donald Trump met with the leaders of the International Longshoremen's Association yesterday. In a social media post, Trump expressed his support for the union and criticized automation, saying, quote, "The amount of money saved is nowhere near the distress, hurt, and harm it causes for American workers." Union members, which walked off the job earlier this year, may strike again in January. And Fox Business reporting that OpenAI CEO Sam Altman is donating $1 million to Donald Trump's inaugural fund. Altman reportedly saying in a statement, quote, "President Donald Trump will lead our country into the age of AI." The commitment will reportedly come as a personal donation from Altman as opposed to from his company. It follows separate $1 million donations from Mark Zuckerberg and Jeff Bezos to the inaugural fund. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, setting you up for the week ahead, this is Bloomberg Surveillance. Counting you down to the opening bell, here's a trading diary through the next week. Monday, S&P Global PMIs. Tuesday, retail sales. Wednesday, this is the big day of the week. A Fed rate decision at 2 p.m. Eastern, followed by a Chair Powell news conference. Thursday, another round of jobless claims and rate decisions from the Bank of England and the Bank of Japan. Friday, core PCE and University of Michigan sentiment survey. Rick Rieder of BlackRock still with us. And you were saying something that I found so interesting before about how you get income now from stocks more reliably, potentially, even than the long end of the yield curve. Does that destroy the idea of 60-40?
I mean, I think, if you think about what 60-40 was, or, the long end of the yield curve was your ballast in the portfolio, was giving your hedging potential, and it worked. By the way, it worked for years when inflation was coming down from where it was in the 80s and 90s. Today, it's a very different. I mean, if you said to me, gosh, I own equities, what would I do with my equity portfolio? First of all, I believe equities are where you compound growth. And particularly today, the ability to compound growth is extraordinary. And your ability to stay in these equities, compound growth, you think about pretty spectacular year in 2024. I think if you go into 2025, you're still throwing off 18% ROE, compound that growth. Then I'd take my income and I'd say, gosh, we talk about real rates and fixed income. If you stay in this 1 to 5 year part, I get a lot of income. If I can create a 6, I compound that income. I get my growth from equity. And they say, well, what's my stopgap? What's my hedge? Equity volatility is incredibly low. Your ability to actually manage a risk portfolio using volatility now, which is super cheap, allows you to create some balance in the portfolio. So today, you can create a lot of income and then optimize where you're compounding growth in the equity market. When I say you get income from equities, I think you get income because you're getting total return appreciation. When I buy a lot of dividend stocks that are slow growers, I don't know, if I can get 6.5 in fixed income and I'm at the top part of the capital stack, I don't know, feels okay to me. And then try and optimize. I think fixed income and equities are really different. Fixed income, I feel like diversify, get as much yield as you can, manage it efficiently. And then in equities, you want to what are the companies that are going to take you to the next level, particularly in an era like this that is strategically evolving so quickly.
Rick, does this feel like a permanent shift? Because this is very different for asset allocation. The idea that you can't have some of these bonds as a haven, as a ballast. Is this just a here and now, or is this a reconsideration this entire industry needs to go through?
Wow, it's a great question. So, you can't say never, but, in the near term, I mean, one of the cool things about the industry, I've been doing it for so long, is there's so many tools now to create precision in a portfolio. You think about the growth of ETFs, futures, derivatives, and obviously cash products and new cash products. The regime shifts every year. We spend a ton of time trying to think through what's the regime for the next year, and then what are the tools that you utilize? Listen, I think the traditional interest rate tool. Listen, I think there's so many. By the way, if you want, you think about an index. Gosh, I get the aggregate index, but I'm getting a bunch of stuff in there. Do I really need it? I've got some long end. I've got some tight spread assets. I can buy an ETF now if I want duration, and I think now we're turning the corner. Rates are coming down. Gosh, I've got it. There's a long end TLT. There's some long end ETFs. I'll get there. I'll get my duration that way. Maybe I'll bring my beta down in my portfolio through, in equities. We talked about options. We talked about other ways you reduce beta in equities. But I just think we're in a new era where you can manage a portfolio in such a sophisticated way because there's so many tools at your disposal.
What is the yield level, just quickly here, that you would find long end yield curve attractive again?
I don't know. It's life changes everything. You got to think about things, but it's not. I don't know. I'll give a level because that gets stamped. But I think I don't think you're there today, and I think you got to see. Over the next couple of months, it's a pretty good non-answer like that first quote that I had.
This is good.
I think that listen, we got to see. There's going to be a point in time that we're going to start to see inflation. That productivity enhancement, that automation effect that's going to come in, and then we'll start to buy some back end assets. It's much more about the environmental condition than, pick the number. And quite frankly, like the Fed, like Chair Powell, I'd like to see the data on policy and see what tariffs really are.
So cheat sheet, when you don't want to answer, it all depends on the data. You need to be an absolute disciplined student of the data. Rick Rieder, wonderful to see you. Thank you so much for being with us, Rick Rieder of BlackRock. Coming up on Monday, don't miss this, Steve Verrone of Federated Hermes, Henrietta Trey's of Veda Partners, Kelsey Barrow of JP Morgan, and Sarah Hunt of Alpine Saxon Woods. Also, there will be a showing from a Jonathan Ferro. Danny Berger, who has been filling in, thank you so much for being with us this week. This was Bloomberg Surveillance.